Hello class, welcome to lesson number 2 of our topic number 5. In this lesson, I will be considering the raising of capital. The raising of capital by companies. Now, you will notice that companies will have two options in the raising of their capital, that they can either raise capital from the members of the public, where they are looking at external sources of capital, particularly share capital. Then they also have an internal, internal options where they can be raising additional capital from within their existing membership. So I want to list a number of ways by which companies will be raising capital, which we shall subsequently be discussing. So we have methods such as a direct invitation available to the company, offer for sale is also an available option to the company. The company could also do placing. We could also have a bonus issue of shares. It is also possible that we have a rights issue. It is also possible that we have a rights issue. We can also look at the possibilities of a conversion issue. It is also possible that we can have a scrip issue. So these are some of the ways that are available for this company to raising share capital. We shall see some of them are external sources, while others will be internal sources. So where this capital is being raised from an external source, we shall be looking at this process known as the flotation process or floating of shares, which is the legal process by which a company avails its securities to the public, by which a company avails its securities to the public. You know, the moment we talk about availing securities to the public, then we are particularly referring to only public companies. Private companies may not have this option available to them. They will not be approaching the publics to subscribe to their securities. So some of these methods involve a public invitation in a flotation process. Others will not be involving a flotation process. So we want to look at them one by one and see which of these methods will be involving the flotation process and which ones will not be involving the flotation process. So beginning with the first of those methods, which is the direct invitation, In a direct invitation, the company intending to raise capital prepares a prospectus. They will be preparing a prospectus, which is an information tool, a document by which the company will be giving information to possible subscribers, to the members of the public about itself. So in this document, the company will tell the members of the public about how long they have been in business, who are the managers of this company, what kind of business they are involved in, how much capital they wish to raise, what number of shares are they issuing, value per share, rights of these shares, a lot of information that is supposed to give the potential subscribers enough information on which they are to base their decision on whether they are going to buy these shares or not. So once the company has prepared prospectuses inviting the public to subscribe for these shares, there is a risk that the members of the public may not respond to this prospectus issue overwhelmingly. For instance, if through a direct invitation where we are issuing a prospectus inviting members of the public to buy securities, let's imagine we want to raise 100 million worth of share capital by way of a prospectus issue. There is a risk that the subscriptions we get from the members of the public could only maybe be at 70 million. Sometimes it could be worse. We may be falling at 70. so that we have a serious deficit with respect to the target of 100 million. Then it therefore becomes necessary that this company doing a direct invitation to raise share capital may now be required to do what we call underwriting the issue. In underwriting the issue, the company gets into contact with an underwriter. Underwriters will usually be investment banks or insurance companies, which will be giving a commitment to the company issuing shares that for some commission, we refer to as the underwriting commission, that they will take up a percentage or the whole of the capital or the whole number of shares that will not be taken up by the public. So possibly they are saying, we will take up everything else that is not taken up in the issue. So if this company invites the members of the public to subscribe to a share capital worth 100 million and the public only take up 70, the underwriting arrangement could be such that the underwriter is to take up the balance of 30 million that has not been taken up. So the underwriting gives the issuing company some confidence that at the end of the day, once we invite the public, even if they do not subscribe to the entire amount of share capital that we wish to raise, then the underwriter can come in and provide the whole of the balance or part of the balance as will be agreed in the underwriting contract between the issuing company and the underwriter. So something that should come out very clearly in the direct invitation, this company that wishes to raise capital by way of a direct invitation will have to go into the details of preparing and issuing a prospectus. Now, in the prospectus issue, there is a lot of publicity that this company has to create, that they have to do a lot of advertisements through TV, through radio, through newspapers, just to sensitize the public. Let the public be aware that we are in the process of raising our capital, that we're in the process of issuing additional shares. Let the public know that there are shares that are available for them to subscribe. And then, of course, with the risk that we run, that all these shares may not be taken up, the issuing company may also have to arrange for underwriting, where they get an underwriter to commit to them that any portion or part of any portion of this share capital that may not be taken up by the public, then the underwriter will provide consideration for such amounts. So that is the direct invitation. We have another option that is available to these companies, which is the offer for sale. An offer for sale. In the offer for sale, the company that wishes to raise capital involves a second company that we shall refer to as the issuing house. So what happens is that the company raising capital will allot. They will allot all the shares. They will allot all the shares to the issuing house. They will allot all shares to the issuing house, so that this issuing house now goes on to take up what the company raising capital would have done. So the issuing house takes up responsibilities such as preparation of the prospectus. They will also be arranging any underwriting if necessary to underwrite the issue. So in a way, in the offer for sale, the company wishing to raise capital gets another company to do the work for them. So this second company is the issuing house. It is the second company that now takes up the responsibility of preparing prospectuses on behalf of the company that wishes to raise capital. If underwriting is necessary, it is the second company that also takes up the responsibility of ensuring that the issue is underwritten by an underwriter. So that when we now have applications made for shares of this company, then the issuing house will be renouncing their allotment in favor of any applicants who apply for these shares. So the main difference we notice between these two processes, in the direct invitation, the company raising capital goes directly to the public, prepares the prospectuses by themselves, and if any underwriting is necessary, they also underwrite by themselves. In the offer for sale, they get assistance. they transfer the responsibility of the issue to a second company known as the issuing house. How so? That they are allotting all these shares to the issuing house, which in turn now issues them to the public. By preparing a prospectus on behalf of them, they also arrange underwriting if necessary on behalf of them. And should we be receiving any applications for the shares of this company, which had been previously allotted to the issuing house, the issuing house renounces their allotment in favor of the applicant that they receive in respect of these shares. Then we have the third option that we may have, which is the placing option. In the placing option, we still have our company that wishes to raise capital by way of issuing shares. But something different you will notice this time round, this company will not be going to the public directly, but still they will be using an intermediary. The issuing house will still be involved. So in the placing option, the company allots the shares, the company allots the shares to an issuing house which then offers them to specific persons, or institutions or organizations. Now, in this case, because we are not inviting the publics directly, then we are saved from the inconveniences and all the costs of doing a prospectus. Then we shall also not be faced with the risks of doing an underwriting. That what the company that wishes to raise capital is doing is, they are allotting all these shares to an issuing house, and then they give them the responsibility of having these shares offered to possible or willing investors. So the issuing company approaches individuals who maybe they have a relationship with, who maybe they are sure that if they pitch to them the idea of buying the shares of this company, then they will. Because of the fact that they are not going to the publics directly, then in this placing process, we are excused from preparing prospectuses. We only prepare prospectuses when the issue is a public issue, when the issue is targeting the public or a section of the public. But in this case, because we are attending to individual institutions, individual organizations, individual persons, then we are excused from the preparation of prospectuses. Now, these two methods will be the preserve of public companies because the public is involved. As you will already be aware of, private companies by their articles restrict the invitation, actually they prohibit the invitation of the public to subscribe to their securities. So they cannot be doing a direct invitation, they cannot be doing an offer for sale. But a placing option is available for them because the publics are not being invited directly. Now, we have these other options available. If you look at these three options, the companies were targeting outside sources to increase their share capital. In the remaining of the sources, then the company will be targeting internal sources to increase its share capital. For instance, a bonus issue. A bonus issue. What will be a bonus issue? This is the issue. This is the issue of additional shares. The issue of additional shares to existing members in proportion to their current holding, for no direct consideration. We are issuing additional shares to existing members in a proportion. We are getting as much as we have, depending on the number we have. So we are issuing these shares in proportion to their existing shareholding. And most importantly, what makes it a bonus is that they are not giving us any consideration directly. They are not giving us any consideration directly. So the question should be, how do we finance a bonus? How do we finance a bonus? Now that we are not getting anything directly from the receiving members, where do we get the money to finance a bonus? Bonuses are financed. Bonuses are financed by reserves. Bonuses are financed by reserves, e.g. retained earnings, e.g. retained earnings. A reserve such as retained earnings could be a possible reserve from which we could be financing a bonus issue. It is because of this reason that a bonus issue is also referred to as a capitalization issue. Bonus issues are also known as a capitalization issue because they present to us an option through which we can capitalize our reserves. For instance, when we plow back our retained earnings and make them part of our capital by issuing or by executing a bonus issue, then we capitalize. The result is that we have capitalized that reserve. Now, for a bonus to be effected by a company, there are some conditions. There are some conditions that are necessary. Conditions for a bonus issue. Conditions for a bonus issue. That there will be some conditions that the issuing company must meet before they proceed on to effect a bonus issue. One of those conditions is that it must be allowed by the articles. We must get the permission of the articles. So the articles must allow. So if the articles of our company do not anticipate a bonus issue being executed by the company, then the bonus cannot be issued. Once we have the articles of the company allowing, then the bonus must be recommended. The bonus must be recommended by the board. The bonus must be recommended by the board. So it comes out of a recommendation of the board that we can increase our share capital by capitalizing a reserve such as the retained earnings. Then with the recommendations, it must be approved. It must be approved by members. It must be approved by members by a vote of the members. So we're imagining a meeting of members where the members are presented with a motion to capitalize reserves such as the retained earnings on the recommendation on the board so that they approve such transaction. Beyond the approval of the members, we're also saying that the company must have sufficient capital. The company must have sufficient capital so that the capitalization should not be a way of creating enough capital for us to work with. This should be seen as extra always. Not that we were already suffering capital crisis or one of the sources of capital we are looking into is a capitalization issue. No. It should always be we are capitalizing to go over and above our present requirements. That we are already not lacking. So when we are in capital problems or capital deficits, then a capitalization issue will not be effected or cannot be effected. The other conditions that we must also be meeting is that it must be within the ratio, allowed by the articles. It must be within the ratio allowed by the articles. So the articles will also go on to tell us how many shares per existing share can be issued as a bonus. So can we get a bonus of 1 share for every 10 existing shares we have, Do we get a bonus of 1 for every 20 shares we have? So the bonus must always again be paid within that ratio that the articles are allowing. Then we are saying that if this company effects the bonus issue, then notice must be given to the registrar. Notice must be given to the registrar. If it so happens that this is a public listed company, then notice has also to be given, or we also have to seek the approval of the markets regulator. In our specific case, we are talking about the Capital Markets Authority. That if the company, in this case, executing a bonus issue, is a public company quoted in the Nairobi Stock Exchange, for them to effect a bonus issue, they will need the approval of the Capital Markets Authority, which is the regulator of the publicly traded companies. So that is the bonus issue and the conditions that we must observe to effect a bonus. The other option we have is the rights issue. In a rights issue, the company is issuing additional shares. The company is issuing additional shares, to existing members in proportion to their current holding at preferential terms, in proportion to their current holding at preferential terms. So one of the differences you would see between a rights issue and a bonus issue is that in the bonus issue, we were not paying anything, so to speak. We were not giving any consideration for the shares we were receiving in respect of our current shareholding. In a rights issue, we are giving something, but this thing that we are giving, the consideration that we are giving, is at preferential terms. Usually, for companies that are traded, listed companies, the rights issue will be executed at a price lower than the market value. So that if the company in question is a listed company and the current market price at the stock exchange is 50, maybe we could be doing a bonus issue at 45. The idea is we are giving an opportunity to existing members to take up more shares at a lower price. That if these members were to buy these additional shares in the market, they would be paying the 50 shillings. We are now giving them an option to take up more at a lower price, say 45, say 46. Anything lower than the market price would be considered to be a preferential term, would be considered to be a better term offered to these members. So rights issue will have the effect of again increasing the company's share capital, but being more so a special opportunity given to existing members to increase their shareholding in the company. That this option is given to the members of the company, that they can take up additional shares at preferential terms by paying less than they would be paying in the market. Now, when the rights issues are being effected by a company, the members will be given 3 options that they can exercise. That members will have 3 options in respect to the rights. That the first option is that they can exercise the rights. In exercising the rights is that they can actually buy those additional shares that the company is offering them in respect to their current shareholding at that preferential rate that they are being given. The second option they have is where they transfer the rights, or simply selling these rights. Now that I have an opportunity to buy these shares at a lower lower price. It could be the case that I have no money to buy, or I am not interested in taking up any additional shares, but they can transfer that right to another member or a non-member to buy such shares that are being offered as part of the rights issue. Then the third option they have is to ignore the rights. To ignore the rights. That is the third option. It appears to be the worst of the options that the members can exercise, where the members are simply doing nothing about the rights. That they are not going to buy additional shares that are being offered at preferential terms. They are also not going to transfer their rights to anybody. So the rights simply expire, and those members forego the option to take up these additional shares at the preferential terms that had been given by the company. So if this is a publicly traded company, that is, it is listed in the stock exchange, then to execute a rights issue, this company will require the approval of the Capital Markets Authority, which is the regulator of publicly traded companies. So that's the rights issue. The other option we have is doing a conversion issue. The conversion issue results out of securities, usually of debt nature, that have the right to be converted into equity. That we have issued debt securities maybe in the form of debentures, and we create rights on these instruments, on these securities, that they are convertible at the option of the holder into equity. In such cases, then we are talking about the converting of debt securities, into equity. Converting of debt securities into equity. So the holders of these debt securities, once they exercise this option that debt has been converted into equity, then the result is that we have an option of having raised our share capital, that our share capital is increased as a result of this new equity created as a result of the converted debt. The point is, for this conversion issue to be effected, the articles must be allowing for such conversion, and the particular debt instrument being converted must have the rights of conversion into equity. Then finally, we have the scrip issue. In a scrip issue, this is an option. This is an option to members. This is an option to members to receive dividend by way of additional shares in the company. So at the year end, once we have declared our dividends that we shall be paying this much per share held, the company can give options to its members via its articles that in our company, we have afforded members the option of taking up dividend by way of additional shares. So for mathematical representation, if we have shares valued at shillings 5, and the dividend payable to an individual member for mathematics purposes being 5,000, then we can be giving an option to this shareholder. Instead of receiving your 5,000 Kenya shillings in the form of cash dividend, we are giving you the option of taking up additional shares. So where the value of a share is now currently 5, then this 5,000 is affording this shareholder some additional 1,000 shares. So in this case, this member is being given this option that instead of taking up in cash form the 5,000 dividend, you have the option of taking up 1,000 additional shares in this company. This is a scrip issue. The effect is that we have given ourselves an option of raising share capital as a company. So, dear class, this is the issues that we wanted to consider in this lesson regarding to raising of capital. We have looked at the various options available to the company, particularly the direct invitation, where the company was targeting the public, issuing a prospectus as well as underwriting if necessary. We have looked at the offer for sale, where the company was transferring the responsibility of the issue to a second company. We have also looked at the placing option, where again the company transfers the responsibility to a second company, but this company does not go to the public directly. It goes to specific persons or specific investors and offers those shares to them. Then we have seen these other methods where we are looking inwards. We are looking at internal sources, where the company can possibly do a bonus issue by offering members additional shares for no direct consideration. We have also seen a rights issue being a possibility, where we are offering more shares or additional shares to members, but this time round at a preferential rate. Then the possibilities of a conversion issue, where the company is offering holders of debt securities the right to convert them into debt. The net effect being that our share capital, equity capital, is increasing. And finally, a scrip issue to those members who are receiving dividends, that we are giving them an option to take up additional shares instead of cash dividend. The result being, again, increasing the company's share capital. So class, that brings us to the end of our lesson 2 on matters raising capital. Thank you.
Hello and welcome back to the lesson. Today we are still on the third bullet of the chapter, the financing decision, which is sources of finances for enterprises. During our last lesson, we made a distinction between internally generated funds and externally generated funds. Today we begin on another segment under the same subtopic. If you have a syllabus, you can see right after the externally generated funds, there is long-term sources, and there is an opening bracket, equity, debt, hybrids, lease finance, venture capital, business angel, private equity, asset securitization and sale, Islamic finance, and initial coin offerings. Those are long-term sources of finance which you are required to study. Then there is another category, medium-term sources, such as medium-term loans and hire purchase financing. Then there is short-term sources of finance, such as overdraft finance, trade credit, issue of commercial papers, accruals, deferred income. So those are the short-term sources of finance that you are required to study. So we will be going through each and every source of finance that has been highlighted in the syllabus. And in looking or studying these sources of finances, we will consider the pros and cons of the various sources of finance, as well as the characteristics of each source of finance. I've highlighted the three categories: the long-term sources of funds, the medium-term sources of funds, and the short-term sources of funds. Today we begin with the long-term sources of funds. The first category is equity. In this lesson, we will study the characteristics of equity. We will study or highlight the pros and the cons of equity. Now, equity, candidates, represents a long-term source of funds for companies, providing capital contributed by the owners or shareholders. So equity is the capital that is provided by the owners of a company. Equity. So what are the characteristics of equity? Characteristics. or features or attributes. We've said equity represents the capital that is contributed by the owners or the shareholders. The first characteristic is ownership stake. Ownership stake. Equity represents ownership in the company. It does what? It represents ownership in the company. Do you understand? And shareholders are the owners. And their level of ownership is proportionate to the number of shares that they hold in the company. So if a company has 100 shares, has issued 100 shares, and one individual has bought 50 of those shares, then such an individual has a 50% stake in a company. If an individual has just bought one share out of the 100, then such an individual has 1% stake in a company. So equity represents ownership in a company. Number two, equity has no obligation for repayment. There is no obligation for repayment. Unlike debt, where there is obligation to pay back the debt, equity does not involve a fixed obligation for repayment of principal or interest. Shareholders only participate in the company's success through capital appreciation and dividends. If you are a shareholder of a company, then you simply enjoy the dividends and capital or share appreciation. We can discuss the third characteristic under risk and return. Risk vis-a-vis return. Shareholders bear the risk of the company's performance. They share the risk of the company's performance, but they also have the potential for higher returns, especially if the company grows and the stock price increases. 4, voting rights. Voting what? Voting rights. Equity shareholders typically have the voting rights in major company decisions, which allows them to influence corporate governance matters, which also helps them influence board elections. Shareholders have voting rights. Shareholders have voting rights. 5, another characteristic can be discussed under the point dividends. Companies may distribute a portion of their profits to shareholders in form of dividends. However, the payment of dividends is at the discretion of the company's management. If the company's management feels that it is not appropriate to pay dividends, then the shareholders may not enjoy any dividends during that particular year. 6, perpetual existence. This is yet another feature of equity. Feature of equity. Equity represents a form of permanent capital contributing to the company's perpetual existence. When one buys the shares of a company, then that money, that capital that is contributed to the company has perpetual existence. It is that perpetual existence of equity that gives the company a permanent existence. Unlike debt, which has a maturity date, But equity does not have an expiry date. Does not have an expiry date. Perpetual existence. So these are 6 characteristics of equity. Let's discuss the pros of equity. The advantages. The first obvious advantage is that equity has no repayment obligations. 1, no repayment obligations. The company is not obligated to repay equity. Equity does not involve a fixed obligation for repayment. And that provides financial flexibility, especially during challenging economic conditions. Shared risks. The company's risks are shared. Shareholders share the business risks with the company. They only stand to lose the amount invested in the shares and are not personally liable for the company's debts. So we know a company is a person, is an artificial person. Shareholders may be artificial persons or natural persons. So the risks, the business risks of a company is shared by the shareholders and the person of the company. Shared risks. 3, equity attracts long-term investors. Attracts long-term investors. Equity attracts long-term investors. The issuers of equity can attract long-term investors who are interested in the company's growth potential, and that can contribute to stable and patient capital. 4, enhanced borrowing capacity. Enhanced borrowing capacity. A strong equity base can enhance a company's borrowing capacity by improving its overall financial health and creditworthiness. A company that has a strong equity base can borrow much more than a company that has a weaker equity base. Another advantage is that equity aligns interests. What are these interests that are aligned by equity? Now, equity aligns the interests of shareholders and management, and shareholders benefit when the company performs well, fostering a sense of shared goals. Equity aligns the interest of the shareholders and the interest of the management. These are 5 pros of equity. We'll move to discuss the cons, the drawbacks, the cons of equity. The first obvious drawback is dilution of ownership. Equity dilutes ownership. Dilution of ownership. Dilution of ownership. Issuing additional shares to raise equity can lead to dilution of existing shareholders' ownership. And this dilution may affect the control and decision-making power of the existing shareholders. When you bring in new shareholders, then the existing control of the shareholders is diluted, because that control is then shared among the existing shareholders and the new shareholders. There is a dividend expectation. Dividend expectations. Shareholders may expect dividends, particularly if the company is profitable, and failure to meet dividend expectations can lead to dissatisfaction among the shareholders. As much as equity shareholders are not guaranteed to dividends, we say that dividends are paid at the behest of the company's management. The company's management decides if dividends will be paid or not. But on the part of the shareholders, by investing in a company, the shareholders expect that dividends will be paid, especially or particularly where the company is profitable. But if the company fails to pay dividends, which is possible or expected, then that can lead to dissatisfaction, and that becomes a drawback of equity. Now, candidate, the value of equity is influenced by market fluctuations, is influenced by economic factors, may be influenced by the sentiments of the investors. So the value of equity is subject to market fluctuations, to market conditions which are not stable. That would mean that the value of a share can fluctuate over time depending on conditions that are beyond the control of the company. The value of equity is subject to market fluctuations, or determined by market conditions. It's determined by the sentiments of the shareholders. Complex valuation. Valuation of equity can be complex. Valuing equity can be complex, especially for publicly traded companies. Why? Because share prices are influenced by various factors, including financial metrics, industry trends, market sentiments, and so on. Five, limited tax benefits. Unlike debt candidates, interest payments on equity are not tax deductible. They are not what? Tax deductible. And that can make equity financing less tax efficient compared to debt financing. Limited tax benefits. So these are 5 cons of equity. We discussed 5 pros of equity. We've discussed 6 characteristics of equity. And in summary, candidates, we can say that equity serves as a long-term source of finance with unique characteristics, with unique advantages and disadvantages. And companies must carefully consider their financial needs, their growth objectives, and also preferences of existing shareholders when deciding to raise funds through equity. And there ought to be a balanced capital structure that involves a mix of equity and debt in order to maximize the benefits of both sources of financing. So these are characteristics, 6 characteristics: ownership stake, There is no obligation for repayment. There is a characteristic in relation to risk and return, voting rights, dividends, and perpetual existence. We say that equity financing makes it possible for a company to have perpetual existence because the equity is not expected to be repaid. Pros of equity, advantages of equity, there is no repayment obligation. The company is not obligated to repay, as is the case for debt equity. There is shared risks between the company and the shareholders. It attracts long-term investors. Equity attracts long-term investors, which is very essential for stability of the company.
Hi Rana, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to look on an illustration question regarding accounting for the conversion of a partnership into a limited company. And I want us, first of all, we go through that particular question and we see what was required. So the question reads, Chada, Pete, Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1 respectively, after allowing for a 10% per annum interest on fixed capital balances and commission entitled to a partner. The following trial balance was extracted from financial record of partnership as at 30th of September 2017 is as set below. So we are given the trial balance there for partnership as at 30th of September 2017. So the first item, we have landed buildings at cost, motor vehicle at cost, office equipment at cost, furniture and fixtures at cost. And then we have the provision for depreciation for buildings, motor vehicle, office equipment, furniture and fixtures. So this is the accumulated depreciation for those particular assets. Then we have investment. We have goodwill inventories as at 30th of September 2017. We have account receivable, account payable, bank overdraft, accrued expenses, a capital account for Chada, Pete, and Kidore. And then you're given the net profit for the year which ended 30th of September 2017. We have the drawings by the three partners, Chada, Pete, and Kidore. And then we have the current account for the three partners, Chada, Pete, and Kidore. Then we have some additional information, note 1 up to note number 3. Note number 1, we are told that Kidore was the only active partner and was entitled to a commission of 15% on annual sales revenue, which averaged to 20 million. So, and then you're told that number 2, the partners resolved to convert their business into that of a company to be named Chapeki Limited with effect from 1st October 2017 under the following terms. 1, we are told investment comprised equity investment which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to the profit share. The investment had a market value of 50 million as at 30th of September 2017. The other point you're told, other assets and liabilities were transferred to the new company at the following agreed values. Landed building 115 million, motor vehicle 25.5 million, office equipment 43.5 million, fixture and fittings 29.55 million, and then inventories at a book value less 5%, account receivables at book value less 2.5%, and then we are told current liabilities were transferred now to the company at their book value. We are told goodwill was considered valueless and therefore was written off. And then you're told the purchase consideration on business purchase was agreed at shillings 250. And the last point of note number 2, we are told the partners were to become shareholders. The company issued ordinary shares at par of shillings 10 each to the partners to satisfy the balance due to them as at 30th of September 2017. And in the last point, number 3, we are told upon incorporation, the new company issued new debentures at par carrying a 14% per annum. And then you're told the cash proceeds from the issue amounting to 50 million were utilized to purchase additional stock of raw materials, additional stock of raw materials worth 15 million. And then you're told accrued expenses were settled in full. So what you are required from this particular question 1 is we prepare the realization account, partners capital account, and Chapeki Limited account to cross off the partnership books. And finally, we are required to prepare opening statement of financial position of Chapeki Limited. This is a question for conversion of partnership into a limited company. Basically, what we said in our first lesson is that whenever a partnership business has been converted into a limited company, the first thing we need to do is to cross off the books of account of the partnership business, simply because that partnership business is dissolved. And actually, we said we prepare 3 main accounts: realization account, partners capital account, and the purchasing company account. Like in this case, the purchasing company is known as Chapeki Limited. Those are the 3 main accounts which we prepare to cross off the books of account of the partnership. And actually, that is what the examiner was requiring as far as Roman 1 of that question is concerned. And then from there, we proceed and then do what? Open the books of account of the new what? A company. So therefore, what we need to do is to start with Roman 1 of that question, whereby we are required to prepare a number of accounts. So the first account we are required to prepare is the realization account. Realization account, that is the first account we are expected to prepare here. And the realization account, basically this is prepared using a T format. Also in Roman 1, we are required to prepare a partners capital account. Partners capital account. Partners capital account. Equally, this is a T account. A T account. So meaning that this account will be having a debit and a credit side. And on the credit side, we are going to have the details column and columns equal to the number of partners. In our case, we have 3 partners. That is, we have 3 partners, Chada, Pete, and Kidore. The same case with the debit side of this particular account, we have 3 columns for the 3 partners. This is the debit side, credit. The same case with the partners capital account. So this is the details column, and then we have 3 partners, Chada, Pete, and then we have Kidore. The same case on the debit side, Chada, Pete, and Kidore. And equally, in Roman 1 of that particular question, what the examiner was requiring us we prepare is another account which is called Chapeki Limited. So remember, Chapeki, this is a new company, and basically the new company we refer to it as purchasing company. The reason being that this particular company is purchasing the business of the partnership. So therefore, we have the other account which is Chapeki Limited account. Chapeki Limited, but which you are saying is the purchasing company account. Purchasing company account. So those are the 3 accounts which the examiner requires to be prepared as far as Roman 1 is concerned. And these accounts basically are prepared in order to cross off the books of account of what? Of the partnership. partnership. So what we need to do before we cross those particular accounts of the partnership, maybe we can just go through the additional information. We see what we are told. And number one, you're given some information about the commission which Kidore was to be entitled to, which you're told it was 15% of the sales revenue. And we are told Kidore is entitled to that commission because he was the only active partner. Being active partner means that Kidore is the one who was running the affairs of this particular partnership business. So we have that information. And then in number two, we are given now the information or the terms of conversion, the asset which were taken over by the new company, the asset which were taken over by the partners, the purchase consideration, and so on. So therefore, what we need to do, or anytime you come across such a question for partnership and whereby the conversion is taking place at the end of the year, the first thing you need to do is to distribute or basically to appropriate the profit which was reported by this particular partnership business among the partners, partners. Once you're through with that, then proceed and you cross off the books of account of what? Of the partnership. And basically, in this case, we do that by preparing something called the appropriation account so that we can be able to do what? To distribute now that particular profit which was reported by the partnership business among the partners. So therefore, let's first of all we do that. Before then, we can proceed and cross off the books of account of this particular partnership business. It is also important for you to note that the figures which are given in the trial balance are in thousands of shillings. So therefore, what we need to do first of all, we take the net profit which was reported, the net profit for the year, and the net profit for the year in our case we are told is 91,000. So remember, take into account this is a partnership business. This profit which was reported during that year should be shared among partners. But before sharing out that particular profit, there are a number of things we need to deduct from this particular profit. Things like interest on capital, things like salaries to partners, things like commission to partners, and so on. So in a case what you're given, in the additional information, number one is the commission to Kidore. So mean that here we list now the appropriations. So the first appropriation we are going to list is the commission to partners. So in our case, we know that it is only one partner who is entitled to a commission, and that is Kidore. Kidore was entitled to a commission equal to 15% of the sales. And in this case, we are told the sales for that year average to how much? Average to 20,000. So we get 15% of that, and automatically that should give us 3,000. Let's just confirm whether that will give us 3,000. So 15% of 20,000. Yes, that will give us 3,000. So this is a commission now which Kidore was entitled to. The other appropriation which we deduct from this is salary to partners. As per the information which you're given in this particular question here, there is no partner who was entitled to a salary. But if any of the partner was entitled to a salary which is an appropriation, we also deduct it here. The other appropriation which we deduct here is something called the interest on capital. Interest on capital. There is some information which you are given regarding this, which is in note number or in paragraph 1 of that particular question, whereby we are told partners were sharing profit and losses in the ratio of 2:2:1 after allowing a 10% per annum interest on fixed capital balances. So mean that the partners were entitled to an interest of on capital equal to 10%. So let's compute the interest on partners, or the interest on capital, that is for each partner. For a Chada, which will be 10% of his capital. Then we have Pete, equally 10% of his capital. And then the last partner, who is Kidore, equally 10% of his what? Of his capital. So how much is the capital balance for each partner? We have that is in the trial balance. And the capital of Chada here was 58,500. For the other partner, it was 37,000. That is Pete. And the other partner, that is Kidore, we have an amount of 31,500. So what we need to do, we get 10% of this. So this will give us 58.50. This will give us is 37. It will give us 3,700. And then this will give us 31 what? 50. So we get the total, we take it to the last column. So the total figure here will be 58.50. 50 plus the 3,700 plus the 31.50. That will give us 12,700, and equally that one should be deducted now from our net profit. Now, after deducting those three items, that is the commission to partners, the salary to partners, the interest on capital, the amount now which remains here, or basically the balance which you get, if a positive figure is a profit to be shared, but if it is a negative figure, is a loss now to be shared. In our case, I hope you can see here, definitely you're going to have a positive figure. So this minus those two figures, we're going to have a positive figure. We less from 91,000, we less 3,000 and 12,700. Yes, that will give us a positive figure of 75,300. Now, this particular figure here, this is a profit now to be shared by partners, or to be shared among the three partners using their profit and loss sharing ratio. So therefore, we have the share of profit, and this profit will be shared by the three partners. Chada, I think we can just use C for Chada, P for Pete, and K for Kidore. And this particular profit will be shared based on their profit and loss sharing ratio. As per the information we have in the first paragraph of that particular question, we are told that the partners were sharing profit and losses in the ratio of 2:2:1. So we need to get the total for that, which is 5, and the share of Chada is 2/5 times that figure, that is 75,300. The same case with Pete, 2/5 times 75,300, and then finally Kidore, 1/5 times 75,300. So that will give us now the amount of profit which each partner was entitled to. So the first partner, we take 2/5 times 75,300, and that will give us 31.20, and that's the same for the other partner. And the last partner will be entitled to a share equal to a profit share equal to 15,060. So then once we add all this, it should give us now this particular amount here, that is 75,300. Yes, and basically after deducting now these three items now from our profit there, we should get now 0. Maybe you can just confirm 91,000 minus 3,000 minus 12,700 minus 75,300. Yes, so that should give us 0. So that is the first thing you do. You take the profit now which was reported by the partnership, and then you do what? You distribute it among the partners. And once you do that, then you go back to the trial balance, and basically you cross off all those particular accounts which had balances at the end of the year, starting from the first item there, which is land and building. But even before you do that, you have to remember, we say that in preparing this particular account, there are a number of things which you record here. For example, when we say that all the assets which are taken over by the new company at their net book value, we debit them in this particular account. The other item, or basically on the other hand, we say that those particular assets which are written off, those particular assets which are taken over by partners, we debit them in this particular account. Also, in the realization account, we credit the liabilities which are taken over by the new company, and also in this particular account on the credit side, we record now the purchase a consideration. So therefore, what we know as per the information we have in or as per the information we have in note number 2 is that a number of assets, including land and buildings, motor vehicle, office equipment, furniture and fixtures, inventories, account receivables, all those particular assets were taken over by the new company. So therefore, all those particular assets which were taken over by the new company, what we do is that we debit them in this particular what? We debit them in this particular account here. We debit them in this particular account here. The first asset is land and buildings. Land and buildings. And we debit that particular asset here at its net book value. So what will be the net book value? The net book value will be equal to the cost, which is 123,500 minus the accumulated depreciation, which is 20,150. So that will give us now the net book value. We're going to compute that. The other asset is motor vehicle. Motor vehicle. So the net book value is 80,600 minus the accumulated depreciation, which is given as 54,600. The other asset which was still taken over is office equipment. The net book value will be 70,200, which is the cost, minus accumulated depreciation, which is 24,400. The other asset which was taken over was furniture and fixtures. The net book value will be 52 minus the accumulated depreciation of 18,500. So these are basically the assets now which were taken over by the new company, and those particular assets we have said in this particular account we debit them. We debit them at the net book value. At the net book what? A value. So let's compute the net book value of this particular asset, starting with the first one, which is landed building 123,500 minus 20,150, which will give us 103,350. The other one is motor vehicle. We have 80,600 minus the accumulated depreciation of 54,600, which will give us a net book value of 26,000. So the other asset is office equipment, whose cost is 7,200 minus accumulated depreciation of what? Of 24,400. That will give us 45,800. And then we have the other asset, which is furniture and fixtures. The cost is 52,000 minus accumulated depreciation of 18,500, and that will give us 33,500. Yes. So we are through with those particular accounting for those particular assets which were taken over by the first of all, those particular non-current assets which were taken over by the partnership, and then below those particular assets, remember I've said we cross off those particular accounts. Don't skip any account. So then from there we go. Remember, you have dealt with those particular accumulated depreciation. Then from there we go to the investment. So there is some information we are given regarding those investment in point number 2. In addition information number 2.1, we are told investment comprised of equity investment, which partners had acquired jointly. Equity investment means that this is an investment in shares, and the partners had acquired those particular shares what? Jointly. So we are told each partner was to take over a portion of the investment, equivalent to the profit what? A share. And then you are told the investment had a market value of 50 million at on 30th September 2017. So this particular investment, which we are told include investment in equity shares. So in the statement of financial, in the trial balance, you can see that this particular investment had a book value of what? Of 44,800. But you are told this particular investment at the end of the year had a value of how much? 50,000. So automatically, this particular investment will be shared by partners at their market value. The market value is how much? 50,000. So, but now the difference here, which is the difference between 50,000 and 44,800. So this one, which is 52, is what? Is a gain on investment, or basically we can refer to it as a revaluation gain on what? On investment. So how do we account for that? So remember, investment, this is an asset. So therefore, the amount which was recorded in this particular account was an amount of how much? 44. 800. Yes. So therefore, what we do, because we need to cross off that particular account, take into account those particular investments were taken over by partners. So we credit this particular account with that particular amount, 44,800, and now this particular gain of 5,200, this will be credited in this account. This will be credited in this what? Account. So basically what that means is that the double entry for this particular investment shared by partners, one, we debit the partners capital account at an amount of 50,000. Then we credit to account the investment account with an amount of 44,800. That's what you have said there. And then with the gain, which is the revaluation gain of 52, this will be credited in the account called what? The realization account. The realization what? Account. So therefore, the entries which we need to make here is what is affecting realization. So 5,200, we can refer to that as the revaluation gain on investment. Investment, which is a figure of 52. So we are not required to prepare the investment account, and then the other entry which we need to make is to debit the partner's capital account with an amount of how much? 50. Remember, we are told that that particular investment will be shared among partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is 2/5, 2/5, and 1/5. So therefore, we debit this particular account with the investment which was taken over by partners. And basically we take 2/5 times what? 50,000 for Chada and Pete. So this will be 10, and that will give us 20,000. 20,000. And then for Kidore automatically will be what? Will be 10. So that is now how we account for those particular assets which are taken over by partners. We said debit the partner's capital account, credit the specific asset account. So then below investment, we go back to the trial balance. Below investment, we have goodwill. And equally, there is some information we have in note number 2 regarding goodwill, whereby we are told goodwill was considered valueless and was therefore written off. Equally, we say that those particular assets which are not taken over by the new company but they are written off, we credit the specific asset account and then we debit the partner's capital account, equally using the profit and loss sharing ratio. So take into account goodwill was written off, that one will be debited in this account and then credited in a specific asset account using the partner's profit and loss sharing ratio. So the profit and loss sharing ratio for Chada and Pete we know is 2/5. 2/5 times the value of goodwill. So in this case, the goodwill had a value of how much? 26,000. So this will give us what? Let's compute that. We have 26,000 divided by 5. So this will give us 52 times 2. So which will give us 10,400. 10,400 for Chada and Pete, and then 5,200 for the other partner. So with that particular goodwill, then from there we have 2 other assets there. We have inventories at the end of there and account receivables. If you go to note number 2, we are told inventories and also account receivables. These are the other assets which were taken over by the new company. Any asset taken over by the new company, the books of account of the partnership, or when crossing off the books of account of the partnership, you debit such asset in this account at the book value. The book value is the value in the trial balance. So we have inventories. The book value, the value in the trial balance is 31,200, and then we have account receivables. Account receivables with a book value of what? With a book value of 25,400. So we are through with those 2 current assets, and then from there we have bank overdraft, accrued expenses, including account payable. There is some information we are given still in note number 2, where we are given the terms of conversion, where we are told all current liabilities were transferred to the new company at the book value. At the book what? Value. And actually those 3 items, account payable, bank overdraft, accrued expenses, all those are current items of current liability. So those three items of current liabilities were transferred to the new company. So we said in closing of the books of account of the partnership, those particular liabilities those liabilities which are transferred to the new company, what we do is that we credit them in this account, in the realization account at the book value. So we have three current liabilities there. Account payables, the book value for that is 62,400. We also have bank OD, bank overdraft. The book value for that is 17,550. And then we have accrued expenses having a book value of 4,000. Having a book value of what? 4,000. So those are the three current liabilities which were taken over. And then from there we go to the other item, which is the partner's capital account. The partner's capital account is crossed off to this particular account. And you can see the partner's capital account in the trial balance is having a what? A credit balance. So therefore that is the first, or basically that one we cross it off in this account and we record it on the credit side. The capital account balance for the first partner is 58,500. For Pete, that is 7,000. And then for the other partner, who is Kidore, is an amount of 500. So we are done with that. And then from there, we have now the profit for the year. The profit for the year, we don't record it in either of these particular accounts, but what we account for is these appropriations, this particular amount which has been distributed to partners, because you can see this profit for the year was distributed among partners. That's what we account for. And all these items here, all these appropriations, they are recorded in this account, the partner's capital account. Anything which a partner is entitled to, including commission, including salary, including a share of profit, including interest on capital, all those items in this account, we do what? We credit them. So let's start with the commission.
Greetings, candidates, and welcome to the lesson. We are going to study the internally generated funds and the externally generated funds under the topic, the financing decision. These are two broad categories of financing sources for enterprises. And understanding the distinctions between the internally generated funds and the externally generated types of funds is crucial for effective financial management. So we are going in our today's lesson to do a comparison between internally generated funds and externally generated funds. That's what we'll study in our today's lesson. Externally generated funds. We'll first of all look at the internally generated funds. Now, our distinction will be based on certain features or characteristics, like the source. Source. Let me put it down here. Source. What is the source of internally generated funds or origin? Candidates, internally generated funds, as the name suggests, originate from within a company's own operations and activities, and is primarily composed of retained earnings, accumulated reserves, depreciation funds, and so on. These funds originate from companies' own operations. The origin, the source, originates from company's own operations or activities. Source. I've given examples. The retained earnings, accumulated reserves, retained reserves, accumulated depreciation funds, and so on. We can also distinguish internally generated funds from externally generated funds on the basis of ownership. 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 Now, internally generated funds do not dilute the control ownership or ownership control of existing shareholders. Do not dilute the ownership control. These internally generated funds do not dilute ownership control. But the externally generated funds, they dilute the ownership control. They do what? They dilute the ownership control. Internally generated funds originates from companies' own operations and activities, but externally generated funds originate from outside. They come from outside sources, like debt financing, like equity financing, and various other capital sources. But internally generated funds, these are funds that originate from within the company's operations and activities. Number two, ownership. Internally generated funds do not dilute ownership control, whereas externally generated funds dilute ownership control. We can also distinguish the two on the basis of cost. Cost. And when we are referring to cost, we can mention something on the cost structure. Generally, internally generated funds do not involve explicit costs, like interest payments, like dividends, and so on. They do not involve explicit costs. Do not involve explicit costs like interest payments, dividend payments, and so on. But externally generated funds involve explicit costs like interest, like dividends, and so on. Cost structure. 4, flexibility. Flexibility. Now, internally generated funds as a source, this source of funding, this source of finances from within the company provides greater flexibility in decision making. Provides greater flexibility in decision making. Provides greater flexibility in decision making. Why? Because the company is not bound by external debt covenants or the expectations of external investors. The company is flexible. If the company wants to use retained earnings, does not need approval from external people or providers. So It's more flexible. These sources, internally generated funds, these sources of funds are generally flexible compared to external sources. Five, stability, financial stability. Now, relying on internally generated funds, when a company relies, let me put it this way, when a company relies on internally generated funds, such a company enhances financial stability, especially during economic downturns. Why? Because the company is less dependent on external sources, is less dependent on the external markets for financing. It's more, provides more stability. Okay? Do you understand? Relying on internal funds enhances financial stability. Enhances financial stability. Do you understand? As you are going to see, as you compare the two, let me have another column here for comparison purposes. This is a column for internally generated funds. You can have another one here for externally generated funds. Number one, on the basis of the source, distinguishing the two, internally generated funds originate from companies' own operations. For externally generated funds, these funds originate from outside the company. From outside, like debt financing, hire purchase, and so on. These funds are originated from outside, and they comprise funds raised through loans, bonds, equity issuance, venture capital, private equity, and other external financing mechanisms. We also distinguished the two based on ownership, and we stated here that internally generated funds do not dilute ownership control. But externally generated funds often involve external investors or creditors, leading to potential dilution of ownership control. This one leads to dilution of ownership control, because new investors are brought into the company, and the existing company, the existing shareholders do not enjoy a monopoly in ownership. The ownership is now shared once new investors are brought on board. Do you understand? Number three, we saw here that internally generated funds do not involve explicit costs, but external funds typically come with explicit costs, such as interest payments for debt or dividends for equity. These funds come with explicit costs. I've mentioned interest payments, dividend payments, and so on. The other distinction is based on flexibility. We saw that internally generated funds provide greater flexibility in decision making, provide greater flexibility in decision making. But for externally generated funds, there are constraints. External financing may come with specific terms and conditions, may come with covenants, may come with expectations, and companies may have to adhere to certain constraints imposed by creditors or investors. External generated funds come with constraints, There are decision constraints. External financing may come with specific terms and conditions. Terms, conditions, come with terms, conditions, covenants, and so on. There is no flexibility in decision making. A company is not free to make decisions when involving external investors, like debt covenants, where maybe the assets of the company are charged on the basis of the debts. A company is not free. So here there is less or no flexibility. Little flexibility, no flexibility compared to internally generated funds. Do you understand? Then there is the aspect of stability. Internally generated funds enhances financial stability, But for externally generated funds, there is what we call market dependency. The company depends hugely on the market. Companies that rely heavily on external financing may face challenges during economic downturns or in volatile markets, such as where external funds are subject to market conditions and investor sentiments. Do you understand? So these are four four points to illustrate the difference between externally generated funds and internally generated funds. And when deciding on whether to opt for internally generated funds or the externally generated funds, there are other considerations that the company can put into that could consider. There are considerations that the company has to look at, like risk and return. The decision to use internal or external funds may depend on the risk tolerance of the company and the return expectations of the investors. And we know that external financing may offer higher leverage, but also provides higher risks and costs. Another factor to consider when selecting either between internally generated funds or externally generated funds is the growth and expansion. For substantial growth initiatives or capital-intensive projects, companies may resort to a combination of internal and external financing. Why? In order to meet their funding requirements. So we discussed 4 points that has helped us understand the distinction between internally generated funds and externally generated funds. The first distinction is based on the source. You say that internally generated funds originate from the company's own operations and activities, but externally generated funds are originated from outside the company. Number 2, the second distinction is based on ownership. Internally generated funds do not dilute ownership control, whereas externally generated funds dilute ownership control. Point number 3 was based on the cost. We saw that the internally generated funds do not involve explicit costs, but externally generated funds come with explicit costs like interest payments and dividend payments. Number four, fourth distinction is based on flexibility. Internally generated funds provide greater flexibility in decision making, but there are constraints when it comes to externally generated funds. Then lastly, the first point distinction is based on stability. Internally generated funds enhances financial stability, whereas the externally generated funds depend on market conditions. There is market dependency. Companies relying heavily on external financing may face challenges during economic downturns or in volatile markets, because such funds are subject to market conditions and investor sentiments. That is the end of today's lesson. Allow me to read 3 questions for your revision. 1. What are the advantages and disadvantages of relying on internally generated funds as a source of financing for enterprises? Number 2. How can enterprises effectively tap into externally generated funds, and what are the various external sources available to businesses for financing? 3. In what situations would a company prefer internal financing over external financing, and vice versa, considering the impact on business operations and financial stability? Thank you for attending the lesson. Bye.
A commission in this case, it is only one partner, who is Kidore, who was entitled to a commission of 3,000. And then we have now salary. So we don't have salary, but in the event you had salary to partners, you equally credit it in this account. And then next we have interest on capital. Interest on capital for Chada 5850, that is 700, and that 150. So we are through with that. And then finally we have the share of profit. So therefore I've said all appropriations, we credit them here. So we have 30, 120, 30, 120, and 15, 0, 60. So we are through with that. Let's go back to the trial balance below. The profit for there we have drawings. Now the drawings, basically that one in this account is supposed to be debited. The drawings to partners, we have the drawing for Chada 78, for the other partner 6,500, and for the other partner 39. And then finally we have the partner's current account. Now the partner's current account, equally we cross it off to the partner's capital account, and you can see those particular current accounts, they had credit balances. So we take those particular credit balances, we bring them in this account on the credit side. If any of the current account is having a debit balance, that should be recorded on which side? The credit side. But none of the current account there is having a debit balance. So all of them are credit what? Balances. That's why we have said we cross them off in this account on the credit what? On the credit side. On the credit side. So basically in our case, you can see what we have done. We have crossed all items which had balances at the end of the year, either in the realization or in the partner's capital account. Then let's go through the additional information. We see whether there is anything we need to capture here. So I think we have dealt with note number 1 about the commission to Kidore. Note number 2, whereby we are given the terms of conversion. We have accounted for the investment which were taken over. We have accounted for the other assets which were taken over, including landed buildings, motor vehicle, office equipment, fixture and fittings, inventory, account receivables. We have also accounted for current liabilities which were taken over, which included account payable, bank overdraft, accrued expenses. We have also accounted for the goodwill, and then we have also, there is something we are yet to account for there, that is purchase consideration. We say that this purchase consideration, which was agreed upon, or the purchase consideration now which the partners are supposed to be paid, that one is debited, not debited, rather credited in the realization, and is an amount of 250 million. We credit it in this account and then we debit it in this account here, which is called purchasing company account. Remember, all our figures here are in thousand of what? Of shillings. So we have the purchase consideration, an amount of 250,000. So we are through with that. And then we are told the partners became shareholders and were issued with the shares. So basically what that means is that this particular purchase consideration will be paid to the partners of the partnership business by being issued with the shares of the new company. So automatically what that means that those who are partners, that is Chada, Pete, and Kidore, will equally become the shareholders of the new what? Company, because they will be paid the amount due to them in terms of being issued with the shares. And then note 3, we are given information. We are told upon incorporation, the new company issued debenture. So these are a transaction by the new company, not by the partnership. So therefore, in our case, I think first of all, we are through with preparing these three accounts. So what we need to do now is to balance off this account. But the first thing which we do is to balance off this account, and the balancing figure in this account is either a gain or a loss on realization. A balancing figure on this side is a loss on realization. A balancing figure on this side is a gain on realization, which is equally shared among partners using their profit and loss sharing what ratio. So let's balance this particular account here. Let's balance this account. So let's start by getting the total on the credit side. We have 5,200 plus 62,400 plus 17,550 plus 4,000 plus 250,000. So that will give us a total of what? A total of 339,150. What about the total on the credit side? We have 103, 350 plus 26,000 plus 45,800 plus 33,500 plus 31,200 plus 25,400. So that will give us a total of, this is the total on the credit. The total on the debit is 265,250. So basically what that means is that the amount which is more is the amount on the credit side, which is 339,150. 339,150, and that means that we have a balancing figure on this side, and I've said a balancing figure on this side is what? Is a gain on realization. Is a gain on realization, and that gain on realization is shared among partners using their profit and loss sharing ratio. Gain on realization. This will be shared between the three partners, that is Chada, Pete, and Kidore, using their profit and loss sharing ratio, which is 2 all over 5, 2 all over 5, 1 all over 5 times now the gain on realization. So the gain on realization will be the difference between those two figures, which is 73,900. 73,900. 900 to be shared, or the share of each partner. So here we have what? We have 29,560. 29,560. Okay, no, that correct? Yes, 29,560. And then we have 14,780. 14,780. Okay, yes, we can just confirm whether that is correct. Yes, that will give us what? That will give us 73,900. So this particular amount, which is shared among partners, then it is crossed off to this particular account. You can see this account is being debited. So what we do to complete the double entry, we credit this account, the gain on realization. So we have 29 560, 29 560, and then for the last partner, who is now Kidore, we have 14,780. 14,780. So once we do that, then equally we come and balance off this particular account. We balance off this particular account, and the balancing figure now in the partners capital account is the amount due to partners. So, or in other terms, it is the amount to be paid now to each of the partner. And basically the total amount to be paid to all partners must be equal to this particular purchase what? Consideration. In terms of how we account for that purchase consideration to be paid to partners, the purchase consideration to be paid to partners, we debit that particular amount in this particular account there, and then we credit this account. We credit what? This account. So let's compute now, first of all, the amount to be paid to Chada. We get the total on the credit side. We less what we have on the debit side. So we have 58,500 plus 5850 plus 30,120 plus 20,800 plus 29,560. And then we less what we have on the debit side here. We have 20,000, we have 10,400, and then we have 78. Yes, that will give us 106,630. So we debit it in that particular account, and then we credit this one. So you have the purchase consideration, which was paid to who? To Chada. And that is an amount of 106,630. 106,630. So we do the same for the other partner. We do the same for the other partner, who is Pete. Equally, we add the total on the debit side, we less what we have on the, we add the total on the credit side, we less what we have on the debit. So we have 37,000 plus 3,700 plus 30,120 plus 18,200 plus 29,560 minus now what we have on the debit, which is 20,000 minus 10,400 minus 65. Minus 65, and that will give us 81,680. We do the same to the last partner, who is Kidone. So we add whatever you have on the credit side of that account, that 1,500 plus 3,000 plus 3,150 plus 15,060 plus 13,300 plus 14,780. 780. Okay, and then we less what you have on the debit side. We have 10,000, we have 5,200, and then we have 3,900. 3,900. That will give us 61,690. Yes, so let's record now that purchase consideration here. The amount paid to Pete, as per our computation there, is 81,680. The amount paid to the other partner, who is Kidore, is 61,690. So basically this particular account now here should automatically balance. So whatever we have on the debit side is 250. Then let's confirm whether whatever you have on the credit side will come to the same. 61,690, 81,680 plus 106. 630. Yes, automatically that will come to what? That will come to 250,000. So basically that's what the examiner was requiring as far as part 1 of that particular question is concerned. And therefore, as far as the first account is concerned here, that is the realization account, these are the entries, these are the items which were being marked there. Those are the items which were marked. In the partner's capital account, these are the entries now which were earning you, the marks are located there. All these, you can see we have so many entries here, so many entries. And as far as this account is concerned, Chapeki Limited, the purchasing company account, those are the items which were to give you some what? Some marks. So in our case, we have done what? We are through with Roman 1. We have crossed off now the books of account of what? Of the partnership. So let's move to Roman 2 of that particular question. We are required to prepare opening a statement of financial position of Chapeki Limited. But before we do that, there are some accounts we need to prepare. The first account we need to prepare is something called the business purchase account. Business purchase account. This account is prepared to determine whether the company acquired or purchased the business of the partnership at a goodwill or a negative goodwill. So how do we prepare this account? This account here, that is a business purchase account, one, we credit it with the asset taken over. We credit this particular account with the asset taken over at their fair value, not the book value. The fair values is what we have in note number 2. Then this account here we debited with the liabilities which were taken over. In this case, whenever the liabilities are taken over by the new company, always liabilities are taken over at the book value. Liabilities are not revalued. And then we debit this account with the purchase consideration. In our case, we know the purchase consideration was 250,000. So we can just record that here directly. And then for the liabilities which were taken over, we know there were 3 liabilities. 3 liabilities. We have them in this account, that is in the realization account on the credit side. So I think we can just get the total for those 3 liabilities which were taken over. So we have 62,400 plus 17,550 plus 4,000. So this will give us what? 83,950. So that is the total value of the liabilities which were taken over. 950. Yes, because we have 62,400 plus 17,550 plus what? Plus now a figure of what? 4,000. Then let's get the total value of the liabilities, of the asset which were taken over. Asset which were taken over at the fair value. And basically that information is given in note number 2. So I think we can have a summary of the assets now which were taken over so that we can get now the total. So which are those particular assets which were taken over as per note number 2? We have land and buildings. Land and buildings taken over at a value of 115,000. We have motor vehicles taken over at a value of 25,500. We have office equipment taken over at a fair value of 43,500, and then fixtures and fittings taken over at a fair value of 29,550. And then we also have inventories taken over at the book value less 5%. In other terms, it means that the inventory were taken over at a value equal to 95% of the book value. So we know the book value of inventory, we have it here as 31,200. 31,200. Still, as per that point, we also have account receivables, which is still an item of current asset, which was taken over at the book value less 2.5%. In other terms, account receivables were taken over at a value equal to 97.5% of what? Of the book value. What is the book value of account receivables? Is the figure we have there, 25,400. 25,400. 400. And therefore, as per the information we have in note number 2, those are the assets which were taken over by the new what? Company and at their book value. So let's get the total fair value of those assets taken over. But let's first of all, we compute the value at which inventories and account receivables were taken over at. We have for inventory 95% of 31,200, which will give us 29,640. What about account receivables? 97.5% of 25,400, which is 24,765. So what we just need to do is to add all those particular assets which were taken over at the book value, at their fair value. At the fair value, 29,640, 29,550, and 43,500 plus 25,500 plus 115,000 plus, yes, I think that is the last figure there, 25. Oh, sorry. So we need to take that afresh. So we have 115,000 plus 25,500 plus 43,500 plus 29,550 plus 29,640 plus 24,765. So that will give us a total figure of 267,955. So therefore, that is the total value of the asset which were taken over. And then from there we balance our account. So any balancing figure in this account on this side is a goodwill, which is an asset to the company. A balancing figure on this side is a capital reserve, which is a component of equity to the company. So on that side, we have that figure. And then what do we have on the debit side? On the debit side, we have 250,000 plus 83,950. So automatically, the total on the debit side is more, with 333,950. 333,950, meaning that the balancing figure is a goodwill here of how much? 267,955. Yes, so which is 65,995. So this particular goodwill we are saying is an asset to the company. So I think having done that, we can now proceed and we finally prepare what is required in Roman 2 of that question, the opening statement of financial position of Chapeki Limited. Roman 2. Statement of financial position of Chapeki, and this is the opening. In other terms, it is a statement of financial position as at the start of the year. So always we start by recording non-current assets. So this one is quite simple because we have all items of non-current asset which were taken over by the new company from the partnership, and basically that is what we have here. That was this summary was quite important. So we have Raded Buildings, which was taken over at a value of 115,000. We have motor vehicles taken over at a value of 43.5. Is it 43.5? That is for equipment. For motor vehicle is this one, 25,500. Then below that we have office equipment taken over at a value of 43,500. Then we have furniture and fixtures. Fixtures taken over at a value of 29,550. Yes, so we have branded buildings, motor vehicle, office equipment, fixture and fitting. So these are items of current assets. And then the other thing we need not to forget is the goodwill arising on business purchase. This goodwill which you have computed there of 65,995. And then next, what we do is to record the current assets. So for the current asset, we can start with what we have here. We have inventories. So for the inventories which was taken over, it had a value of 29,640. But you also have to remember the information or what you are told in additional information number 3, that this particular company issued some debentures which had a value of 50 million. And out of that particular cash which was received of 50 million, this company acquired additional raw materials or acquired additional inventory having a value of 15 million. So therefore, the value for inventory will automatically do what? Increase. So therefore, we need to add the two figures which will give us what? 44,640. And then the other item here is account receivables. The account receivables, which is how much? Which is 24,765. 24,765. Then also take into account our company here issued some debentures having a value of 50 million. It means that our company raised some cash. So therefore, we need to prepare the bank account so that we do what? We determine the bank balance. We prepare the bank account. So first of all, when preparing this bank account, the first thing we record is the overdraft, which was taken over, of which an overdraft in this account always should be recorded on the credit side. The overdraft was having a value of what? 17,550. And then from the information we have in note number 3, this company issued debentures, issued 14% debentures, and our company raised how much? 50 million. So that amount received by the company should be debited in this account because this is cash received. And then also we are told our company did two things from this cash. One, our company purchased additional inventory having a value of what? 15,000. And also the company paid the accrued expenses which were taken over from the partnership. I hope you can remember the accrued liabilities taken over had a value of how much? 4,000. So what that means is that we balance that account, we determine what was the bank balance, what was the cash in the bank at the end of the year, or basically at the start of the year. So we take what we have on the debit side, which is automatically more, minus 17,550, minus 15,000, minus 4,000. So that means that there was a bank balance of 13,450. So this is the cash which was in the bank, and it is a component of current asset, 13,450. And then from there, what do? We get the total assets. The total assets. We add everything which is here. So the total assets, the total assets, I think we have gotten the total here. And this total included what? Included this, that, excluding what? The goodwill. Also include, this, excluding now the amount of 15,000. And then also included that, didn't include that. So therefore to this figure here, 267,955, instead of adding those particular items again, we need to add the goodwill, 65,995. What else is not included here is this inventory of 15,000. So we add 15,000, and also we add now the bank balance, which is 13,450. So let's add those figures. We have 267, 955 plus 65, 995 plus 15,000 plus 13,450. That will give us a total asset of 362,400. So those are the total assets. Then from there, we proceed, we record the financials. And because this is a company, what we record here is equity. Equity is share capital and reserves. So the first thing we need to record here is the company's ordinary share capital. And what we know is that our company here, which is Tapeki Limited, was to pay the partners a total amount of 250,000. I hope you can remember that as per the information given in note 2. And then we are told that amount which was to be paid by the new company to partners was to be paid by the new company in terms of issuing shares. So mean that this company issued shares which had a value of how much? 250. So in this case, we don't have any other item of equity, but after preparing this particular account, if we got a capital reserve, that capital reserve, we bring it here as a component of equity. And in our case, we don't have either any. So then next, what do we record? Non-current liabilities. Non-current liabilities. Is our company having an non-current liability? Yes, we have to remember our company issued 14% debentures. These debentures to this company, this is what? This is a This is a liability, a non-current liability, having a value of what? 50,000. And finally, we record what? The current liabilities. We record the current liabilities. Current liabilities. So in our case, what we know is that our company here, that is Chapeki, took over 3 liabilities from the partnership. Which were those liabilities? We have account payable, we have bank overdraft, and then we have accrued expenses. But basically what we know first of all, as per the information we have in the last sentence of note number 3, is that this accrued liability was paid. And also from the bank account which I have prepared here, we have seen that this bank overdraft was also repaid because there was money which was raised by the company from the issue of this word debenture. So therefore, the only current liability which remained is account payables. Account what? Payables. What is the value for account payables? Is 62,400. 62 for what? 400. And then from there, what we need to do is to get the total equity and what? And liabilities. Total equity and liabilities. So the total equity and liabilities, we add what we have here. This is 300,000 plus 62,400, which will give us 362 for what? 400. You can see whatever you have there is basically the same with what? The total asset. The total asset. So therefore, that is it, that what was required as far as that particular question for conversion of partnership business is concerned. And that brings us now to the end of that particular topic, which is accounting for conversion of partnership business into a limited company.
Hello and welcome back to the lesson. Today we continue with the analysis of short-term sources of financing, our attention being drawn to the overdraft finance. In this lesson, we will study the characteristics, the benefits, and the disadvantages of overdraft finance, which is a short-term source of financing commonly used by businesses to manage their working capital needs. An overdraft is an arrangement between the bank and the account holder where the bank allows the account holder to withdraw money in excess of what the account holder may have or may hold in the bank. So it is a short-term source of finance that is commonly used by businesses to do what? To manage capital needs. It's a short-term source of finance, and we will first of all highlight the we are going to highlight the characteristics of overdraft finance. The first one is in relation to credit line. Overdraft finance provides businesses with a revolving credit line. Revolving credit line, which means that the facility can be used repetitively. You understand? Revolving. All right. The revolving line allows businesses to withdraw funds up to an approved limit. It acts as a flexible borrowing arrangement. Number two, short-term nature. Short-term nature. Overdrafts are typically short-term borrowing solutions that are designed to cover for temporary cash shortages, temporary cash flow shortages, or they are used to bridge the gap between inflows and outflows. A business may have fluctuating cash inflows and outflows. So the overdraft serves as a bridge between the two. It's a short-term financing solution. 3, renewable. Now, overdraft facilities are often renewable, meaning businesses can use them repeatedly as long as they remain within the approved limit, as the businesses meet the terms and conditions of the overdraft that is set by the banks. Variable interest rates. Variable interest rates. Overdrafts have interest rates that are generally variable and may be tied to a benchmark rate such as the prime rate, and therefore the interest rate is usually charged only the outstanding balance. It is charged only the outstanding balance, which makes it variable. 5, collateral required. There are some overdrafts that may require collateral, others may not require collateral. Overdrafts may or may not require specific collateral. For example, you may have secured overdrafts. You may have unsecured overdrafts. Secured overdrafts have a lower interest rate, while unsecured overdrafts have a higher interest rate. The sixth characteristic is in relation to assessment, credit assessment. Credit assessment. Before approving an overdraft, banks assess the creditworthiness of a business, considering factors such as the ability to pay, the financial stability, the credit history of the account holder, and so on. There is also flexibility in usage. Flexibility in usage. Now, businesses have the flexibility to use the overdraft funds in various short-term needs, such as covering operating expenses, paying suppliers, such as managing seasonal fluctuations, and so on. There is flexibility in how the overdraft can be used by the business. 8, quick access to funds. Overdraft facilities can enable organizations or companies to have quick access to funds. thereby allowing or enabling businesses to meet their immediate short-term needs. Number 9 is that this type of finance is not suitable for long-term financing. Not suitable for long-term financing. Overdraft facilities are not suitable for long-term financing. Why? Because they are not intended for long-term financing needs. They are best suited for short-term and temporary short flow requirements. Do you understand? And therefore, businesses need to be careful when managing overdraft facilities to avoid exceeding the approved limit and to avoid incurring unnecessary fees. So these are 9 characteristics of overdraft finance. Let us outline the advantages. What are the advantages of overdraft finance? The first one is flexibility. Flexibility. Overdrafts provide businesses with flexibility in managing their working capital. They can draw funds needed up to the approved limit to address short-term cash flow gaps. 2, quick access to funds. Quick access to funds is an advantage. Overdrafts offer quick and easy access to funds, providing a rapid solution to unexpected expenses or fluctuations in cash flows. And this is particularly beneficial in emergency situations, because a company may be allowed to withdraw anytime in excess of certain limit that has been agreed upon. 2, 3, interest on utilized funds. This is yet another advantage. Here, businesses only pay interest on the portion of the overdraft that has actually been utilized, and that makes it a cost-effective solution for short-term financing. 4, versatility in usage. Versatility in usage. Versatility in usage. Now, overdrafts can be used for various short-term purposes, such as paying suppliers, covering operating expenses, or managing seasonal fluctuations in cash flows. There is no it's not a must that the overdraft be used to finance a certain project or to be used in such a way. No, there is that flexibility and versatility in the way in which the overdraft may be used. The bank does not insist on the funds being used in a certain way. The business can use the overdraft to meet any short-term requirements. Versatility in usage. 5, revolving credit line. Now, overdraft facilities are often revolving, meaning businesses can use them repeatedly as long as they stay within the approved limits and adhere to the terms and conditions of the overdraft. Revolving credit line. It can be used repeatedly. Fixed repayment schedule. fixed repayment schedule. Now, unlike term loans, overdrafts typically do not have a fixed repayment schedule. Repayments are made and when funds are deposited into the business account. That is number 6. Number 7, seasonal support. Seasonal support. Seasonal support. Now, candidates, overdrafts are often used to manage seasonal variations in cash flows. And by so doing, the overdrafts help businesses navigate periods of increased expenses or periods of reduced revenues. So these are 7 advantages. We will highlight the disadvantages here. What are the disadvantages of overdraft finance? Number 1 is the interest cost. The first disadvantage is on interest cost. The interest costs. Overdrafts can be more expensive in terms of interest costs compared to other forms of short-term financing, and the interest may be higher, especially for unsecured overdrafts. 2, risk of overutilization. There's also the risk of overutilization of the overdrafts, where businesses may exceed the approved limit, leading to higher fees and potential financial strain. 3, fees and charges. Overdraft facilities often come with fees and charges, including usage fees, service fees, and potentially penalty fees for exceeding the approved limit. And these costs can add up over time. They can add up over time. 4, continuous monitoring. Continuous monitoring is also a disadvantage. Banks may continuously monitor businesses with overdraft facilities. If there are significant changes in the business financial condition, then the bank may adjust the terms of or the limit of the overdraft. So businesses that use this source are subject to continuous monitoring by the banks. 5, not suitable for long-term, not suitable for long-term needs. Overdrafts are not intended for long-term financing needs, and businesses with ongoing capital requirements may need to explore alternative financing options. There is also credit worthiness requirement. Credit worthiness requirement. Now, businesses need to have a good credit history and financial stability to qualify for overdraft financing. And some businesses may find it challenging to secure overdraft financing if they have weaker credit profiles. 7, repossession risk. There is also repossession risk associated with overdraft financing. Now, while overdrafts are typically unsecured, the bank may have the right to demand repayment or reduce the credit limit if the business financial position deteriorates significantly. Another risk associated with overdraft is dependency. Dependency risk. Dependency what? This over reliance on overdrafts as a primary source of a working capital can create dependency on the bank, and businesses may face challenging times or challenges if the facility is unexpectedly reduced or withdrawn. So these are disadvantages. We began by looking at the characteristics. The first characteristic is in relation to credit line, short-term nature. Number 2, number 3, renewable. Number 4, variable interest rate. Number 5, collateral requirement. Number 6, credit assessment. Number 7, flexibility in usage. Number 8, quick access to funds. Number 9, not suitable for long-term financing. We've identified 7 advantages of overdraft. Number 1, flexibility. Number 2, quick access to funds. Number 3, interest on utilized funds. Number 5, versatility in usage. Number 5, revolving credit line. Number 6, fixed repayment schedule. Number 7, seasonal support. Here are 8 disadvantages. 1 is related to interest. Number 2, risk of overutilization. Number 3, fees and charges. Number 4, continuous monitoring. 5, not suitable for long-term needs. Next, creditworthiness requirement. Number 7, repossession risk. Number 8, dependency risk. So these are characteristics, advantages, and disadvantages of overdraft finance. And candidates, businesses that are considering overdraft finance should carefully weigh the advantages against the disadvantages based on their specific needs, based on their financial condition, and also the cost of borrowing. And it's essential to have a clearer understanding of the terms and fees that are associated with the overdraft and to use it judiciously in order to avoid potential financial challenges. That is the end of the lesson. But before we close the lesson, I will give you today's assignment on overdraft finance. Overdraft finance. Question number 1. What is overdraft finance and how does it function as a short-term source of financing for businesses? Number 2, how do businesses utilize overdraft facilities to manage cash flow fluctuations? And what are the key features of overdraft arrangements with financial institutions? Number 3, what are the associated costs and considerations of using overdraft finance? And how can businesses effectively manage and minimize interest expenses? Thank you for attending the lesson. In our next session, we are going to study trade credit as a short-term source of finance. Bye-bye.
Hi Rana, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the subtopic number 1 of topic 2, that is revenue recognition at the IFRS 15. Remember, in our previous class, we looked on how revenue should be recognized at the IFRS 15 and also the various steps to be followed by an entity in terms of recognizing revenue. And then we went further and looked on how IFRS 15 should be applied in various contracts with customers. We have looked on how IFRS 15 is applied in hire purchase contract and also what we refer as a consignment sale. So in this particular session here, I want us to look on how revenue is recognized and what we refer as a construction contract, and we are going to see on what is the rules, the principles, read down under IFRS 15 regarding recognition of revenue under what we refer as a construction contract. First of all, when talk about a construction contract is a contract which is entered into by an entity with a customer, whereby the entity is expected to undertake some construction work, which will take a substantial period of time for it to be completed, e.g. 2 years, 3 years, 4 years. And once the construction work is completed, the entity will be paid something called a construction or will be paid something called the contract price. So meaning that a company, for example, can secure a construction contract which will take maybe 3 years, and the company will be paid a contract price of a certain amount of money, maybe 100 million. So a question here arises, when should the company recognize that 100 million as a revenue? So IFRS 15 now comes in here to provide some rules regarding how that particular revenue should be recognized. But even before you look on that, maybe we can define what is a construction contract, and then we see how the revenue should be recognized as far as these particular contracts are concerned. So we can say this is a contract where an entity is expected to undertake construction work which is expected or which will take substantial period of time to be completed. So mean that if an entity or basically a company secure a construction contract, and that construction work will take substantial period of time. When we talk about substantial period of time, we are talking of a period beyond one financial year. That construction work will take a substantial period of time for it now to be completed. That is known as a construction a contract. Now, what you have said is that IFRS 15 set out some rules regarding how the revenue should be recognized under such a contract, of which, according to that standard, revenue here should be recognized based on the progress of work. Based on what? The progress of work, or basically revenue should be recognized based on the work which has already been completed. And because in this case we are saying that construction contract will take maybe 2 years, 3 years, what the entity which is undertaking that particular construction work should do, so that it can be able to determine the amount of revenue to be recognized in each financial year, is to estimate the percentage of completion. To estimate the percentage of of completion, of which in this case we are going to look on the various methods which may be used by an entity in terms of determining the percentage of of completion. But even before we look on those particular methods, we can say that here revenue will be recognized, or we can say revenue from construction contract will be recognized, or is recognized based on the progress toward completion, on the progress toward a completion, i.e. revenue is recognized based on percentage of completion, based on percentage of of completion. So the revenue to be recognized in any financial year, in this case we are saying, will always be based on the percentage of completion. The percentage of completion. Basically what that means is that if, for example, the company has secured a contract, a construction contract, and maybe at the end of the first year, the contract, for example, is 30% complete. is 30% complete. We are going to look on how this percentage of completion is determined. We have various methods. Assuming at the end of the first year, the construction cost contract is 30% complete, and then the contract price, which the company is to be paid by the customer, is something like 500 million, then the amount to be recognized as revenue in the first year, here we are saying should always be based on what? The percentage of completion. Take the percentage of completion, multiply that with what we refer as the contract price. So that will give us now 150. So that is now the revenue which is supposed to be what? To be recognized. That's why we are saying that according to IFRS 15, the revenue here should always be recognized based on the progress toward what? Completion, or in very simple terms, revenue will be recognized based on the percentage of what? Of completion. Now, how do we determine this particular percentage of completion, which then is used by the entity in terms of determining the revenue to be recognized in a certain what? Financial year. So let's look on methods. Methods of determining percentage of completion. Methods of determining percentage of completion. So we have a number of methods, around 5 methods. So the first method is known as the cost to cost method. A cost to cost method. So under this particular method here, the percentage of completion of a construction contract is computed, or basically is determined based on the cost which has been incurred to date in proportion to the total estimated contract cost. So mean that to determine now the percentage of completion, under this particular method here, what do? We take cost incurred to date, all over total estimated cost, all over total estimated what? Cost, and then we multiply that with 100. So that's how we determine the percentage of what? Of completion. And basically this is the common method. This is a common method which is used in terms of estimating the percentage of completion. So the other method number two, we refer to it as the output method. So this particular method here, or under the output method, the percentage of completion is determined based on the output achieved so far. So if, for example, the company has secured maybe a construction contract, and that company is expected to construct maybe some residential houses like 100 units, and maybe at the end of the year, the company has been able to construct like 10 units. So in that case, what we do here to determine the percentage of completion, take the units which have been completed 10, divide that with what? The total units which are expected to be completed times 100. Times what? Times 100. So mean that here, to determine the percentage of completion, what we do is that we take the output achieved to date, and then we divide that with the total expected output. Times what? Times 100. So that is the other method which is used in terms of estimating now the percentage of what? Completion. So the other method, we refer to it as the survey of completion. So therefore here, the percentage of completion is determined by a third party or an expert by assessing, going to the field and basically checking the work which has already been done, and maybe from his experience he can be able to advise the entity that work is complete up to which percentage, and the entity now will use that particular percentage in terms of determining the revenue to be what? to be recognized. So therefore here we can say a survey is conducted by a third party, or an expert to determine percentage of completion. To determine the percentage of what? Of completion. So here we don't have any computation which is done, but we are saying that the entity here will engage who? An expert or even a third party to do what? To go to the site and be able to use his experience and advise the entity the percentage of completion of that particular what? Work. Then from there, we have the other method which is called technical estimates. Technical what? Estimates. So when talk about the technical estimate method, so here the entity will use, for example, the engineer to do what? To estimate now the percentage of what? Of completion, or in other terms, to advise the entity on the percentage of what? Of completion. So therefore, we can say that this entails use of an engineer, use of an engineer to do what? To estimate percentage of completion of a construction contract. And once now the engineer is able to do that, he has estimated the percentage of completion. He will go ahead and do what? Advise the company on the same. So then we have the last method which is used in terms of doing the same, estimating the percentage of completion, which is called the time-based method. Time-based method. So when talk about the time-based method, so here the revenue will be recognized, or in other terms, the percentage of completion will be estimated, or will be determined based on passage of time. Meaning that if, for example, a company has secured a contract and the company expect that that contract or that construction contract would be completed in the next 3 years. So mean that once the first year is over, then the company can say that that contract is 30% complete, and therefore the revenue now to be recognized in the first year will be a third, or maybe 30% of the contract price. So therefore here we can say that revenue here will be recognized. Revenue is recognized based on the passage of time, or in other terms, we can just say that the percentage of completion here is determined based on the passage of what? Based on the passage of time. So there was a question which was there in the past papers, and which was requiring you to explain some of these particular methods which are used by the entity in terms of estimating now the percentage of completion of a construction contract. So I also give that as an assignment at this point. This is a question for May 2019, which is question number 4B. So that question was requiring you just discuss two methods used in terms of determining the percentage of completion, of which, remember, you have said that these are like the two common method, output, and also the cost to cost method. Method. Make sure you check on that particular question and you attempt it. You also attempt it. Then from there, want us now we proceed and look on the accounting treatment of this particular construction contract. So the revenue which is recognized, the cost which is recognized in a certain financial year, and also how the profit is arrived at as far as the construction contract is recognized, is concerned, that is, and how an entity determines something called a contract asset and also a contract a contract liability. So let's look on the accounting treatment. Accounting treatment of a construction contract. Construction contract. So once a company has secured a construction contract, at the end of each year, the company should determine the profit or the loss to be recognized as far as that particular construction contract is concerned. So an entity should do what? Determine the profit or what? The loss to be what? To be recognized. We are going to look on how this profit or loss to be recognized in a certain financial year is determined. And two, an entity should be able to determine something called the contract asset or liability to be recognized in the statement of financial position. Remember, this a profit or loss. This one should be recognized in the income what? In the income statement. So let's start by looking on how we determine the profit or the loss to be recognized in a certain financial year. A profit or loss to be recognized. Profit or loss to be recognized. So how do we determine this? So number one, we take the revenue. We take the revenue to be recognized in that year, and the revenue to be recognized in a certain financial year as far as the construction contract is concerned. This one we have said is always based on the percentage of what? Completion. Percentage of completion. The first thing you need to do as far as the construction contract is concerned, you determine the percentage of completion, because we are saying according to IFRS 5, the revenue to be recognized in a certain financial year always is based on the percentage of what? Completion. So determine the percentage of completion, and basically I've said these are the two main methods. Actually, this is the common one. This is a common one whereby you take the cost incurred to date all over the total estimated cost. So take the percentage of completion, then multiply that with the contract price. Multiply that with the contract what? Price. So you'll get now the revenue to be recognized during that financial year, and then to this you lay something called the cost of sales. So how do we determine the cost of sales? The cost of sales equally, this one is equal to percentage of completion per construction contract, and then we multiply that with now the total estimated cost. The total estimated cost. The total cost to be incurred for that contract to be what? To be completed. So what you get here, if a positive figure is a profit, if a negative figure is a loss, to be recognized. To be recognized during that year as far as this contract is what? Is concerned. So that's how the profit or the loss to be recognized in a certain financial year as far as the construction contract are what? Are concerned. So let's look on how we determine then the contract asset stroke liability. Number two, contract asset stroke liability. And we are saying that this is recognized as an asset or liability in the statement of financial position. So in terms of how we determine this, one, we take the cost which has been incurred to date, the cost incurred to date, the cost incurred to date, and then to this we add or less the profit or the loss recognized during that year. So the profit is added, whereas now the loss is what? Is deducted. And basically this particular profit or loss recognized, this is now what you have you will have computed here, the profit or loss recognized during that year, and then to this you less the amount what? Invoiced and received. Amount invoiced and what? And received. The amount which has been invoiced and what? And received, that one should be deducted. And once you do that, you can get a positive figure here or a negative figure. So if you get a positive figure, we refer to that as a contract asset. A contract asset is like what? Is like amount which the client has not yet paid. This is basically an asset, contract asset. Whereas now a contract liability, this whereby a company which is undertaking the construction work maybe has received some amount in advance. There is some prepayment by the client. So that is basically what? A liability. So this one we have said will be recognized as an asset or liability in the statement of financial position. So therefore, these are the two items which, if you come across a question maybe from this particular topic, the examiner may require you to compute. You may be required to compute the profit or loss to be recognized during a 30-year and the contract asset or the contract what? The contract liability. So we also have a question as far as that is concerned. The same question there for for May 2019, and that is part C. So that is what I want us to do as an illustration of this subtopic of construction contract. So we have May 2019. Question 4C. So we go through the question, you see what we are told, and we are told Mijego Construction Limited carries out work on 4 construction contract during the year which ended 30th April 2019. So we are given the details of the contract. So we have the first contract A01, B02, C03, D04. Those are 4 construction contract. The figures are in million of shillings. We are given the contract price, the costs to date, the total estimated cost or the estimated total cost. We have the payment on account. When we talk about the payment on account, this is now the amount invoiced and what? Received. The amount invoiced and also what? Received. Basically, this is a payment on account. Amount invoiced and what? Received. And then we have the revenue recognized in the previous period, the cost incurred in the previous period, the administrative cost for each construction contract, and then you are given the commencement date, the date when each construction contract commenced. And then we have some additional information. You're told the company does not recognize profit until a contract is at least 5% complete. 2, the company's policy is to calculate the percentage of completion on the cost basis, meaning that the company determine now the percentage of completion using which method? The cost to cost method. 3, we are told the company prepares separate trading account for each word contract. So what you're required to do in Roman 1 is we prepare the trading account for each contract, showing clearly the revenue to be recognized for the year which ended 30th of April 2019. Number 2, the income statement extract for the year which ended 30th April 2019, and then an extract of a statement of financial position showing the combined totals for all what the contract. So what is we are required as far as Roman 3 is concerned is now we determine the contract what asset and what liability, because this contract as a contract asset or liability, we have said we take it to the statement of financial position. So therefore we start with Roman 1 whereby we are required now to prepare now the trading account for each contract. Now even before we do that, because in that case we are required to prepare the trading account showing clearly the revenue to be recognized, we have said that in this particular construction contract the revenue are recognized based on the percentage of what? Completion. So therefore the first thing we need to do here, determine the percentage of completion. From there you'll do what? We proceed, determine the revenue to be recognized during the current year, and also the cost to be what? To be recognized. So therefore that is the first thing we need to do here, to determine the percentage of what? Of completion, percentage of completion, for each contract. Which method is being used by the company here? As per note number, additional information number 2, we are told the company policy is to calculate percentage of completion on cost basis, meaning that this one is determined using this formula, the cost incurred to date, all over total estimated what? A cost times what? Times 100. So we need to determine the percentage of completion as far as the 4 contracts are concerned. I hope you can see we have 4 construction contracts. We need to determine this for each contract. So which are those contracts? We have the first contract A01, we have B02, we have C03, and then we have D04. D04. So we need to determine the percentage of completion for each of these construction contract. Percentage of what? Completion. We're using this formula here. So we take the cost incurred to date for each construction contract. The cost to date for the first one is 180. This one is 480. This one is 963.6. This one is what? 33.6. So that is the cost incurred to date, because that is a formula we are applying there. We divide that with what? The total estimated cost. Are we given that? Yes, we are given the estimated total cost. For this one is 720. Definitely we multiply that with 100. For this one is 768 times what? Times 100. This one is 1069.2 times what? Times 100. And finally, we have this one, which is 840 times what? Times 100. So we need to determine now the percentage of completion, the percentage of completion for each contract here, for each contract. So the first one, we take 180 divided by 720. So this will give us 25%. 25%. The other one, we have 480 divided by 768 times 100, which is 62.5%. What about the other one? 963.6 divided by 1069.2 times 100. And this contract is 90.12% complete. What about the last one? We have 33.6 divided by 840. 840 times what? Times 100. So this will give us 4%. For what? Percent. Equally, there is some information which you are given as far as that question is concerned, and we are told in additional information number what? Number 1, that the company do not recognize profit until a contract is 5% complete. So if you check on this particular percentage of completion which you have computed here, you'll be able to see whatever you have gotten for the last contract is less than 5%. Less than 5 what? Percent. If that is the case, a contract is less than 5% complete, it means that no revenue will be recognized. No revenue to be what? To be recognized. To be recognized. No revenue will be recognized. But for the other contract here, revenue will be what? Will be recognized. So what we also need to do before we proceed and prepare now the income statement, let's determine the revenue to be recognized. The revenue to be recognized. To be recognized. Remember, I've showed you how we compute this revenue to be recognized. We say the revenue to be recognized here. Revenue to be recognized here is always based on what? On the percentage of completion. Percentage of completion times the times what? The contract price. So we take the percentage of completion times what? The contract price times the contract price. So that's what we need to do here. So for the first contract, we take 25% times the contract price. The contract price is 780. But if you check on the information which you are given in that question, or in that contract, this contract commenced back in 2017, and we are required to determine the revenue to be recognized in 2019, and that's why down there we are given the revenue which has been recognized in previous years. We are given the revenue, for example, recognized in 2017 and 2018. So therefore, up to this stage, the revenue now to be recognized should be 25% of this. But in this case, we have to exclude the amount now recognized in the previous years. So the amount recognized in the revenue recognized in previous years here is 78. So that will give us now the amount to be what? The revenue to be recognized during the current year. The same case for the other contract. We take the percentage of completion, 62.5, times the contract price, which is 1200, equally minus the revenue recognized in previous period, 180. So we do the same here, 90.12% times the contract price, which is 1020, minus revenue recognized in previous periods, which is 504. And here we have said that no revenue will be recognized. That contract is less than 5% what? Complete. Less than 5% complete. So let's compute this. So we take 25% times 780 minus 78. So that will give us 117. So that is the revenue to be recognized during the current year. During the current year, you have to also remember that these figures are in million of shillings. Million of shillings. So what about the other construction contract? 62.5 percent times 1200 minus 180. So that will give us 570. 570. What about the other one? 90.12 times 1020 minus 504. So which will give us 415.2. So in that case, we have said no amount which will be recognized there. No amount which will be recognized as far as the last contract says what is concerned. Okay. Yes. So I think having that, we already have now the revenue to be recognized. So before we proceed equally and prepare now the trading account for each construction contract, we also need to determine the cost to be recognized during the current year. Cost to be recognized during the current year. Remember also from our format there, we have looked on how we determine the cost to be recognized. The cost to be recognized. We have said take the percentage of completion times the total estimated cost. The total estimated cost to be incurred in completing that contract. We do the same here. Take the percentage of completion times the total estimated cost. For the first contract here is 720, but equally here we are going to less the cost recognized in the previous periods. Cost recognized in previous period is 60 million. We do the same for the other construction contract. The percentage of completion times the total estimated cost, 768, minus the cost previously recognized, 72. Here we take the percentage of completion, 90.12, times what? Times the total estimated costs, which is 1069.2 minus the cost recognized in previous period, which is 480. Equally, no cost is to be recognized as far as the last contract is concerned. So let's compute this. So here we have 25% times 720 minus 60, which will give us 120. Then we have 62.5 times 768 minus 72, which will give us 408. And then finally here we have 0.9012 times 1069.2 minus 480, which will give us 483.6 0.6. So in our case now we have what? We have the revenue to be recognized and also the cost to be recognized. So having that now, we can proceed and prepare the trading account for each construction contract. Why are we preparing that trading account? Is for us now to determine the profit to be what? To be recognized, the profit or loss to be recognized. I've said to do that, we take the revenue to be recognized, we less now the cost. And actually we have been able to determine those two items there. So let's prepare now the trading account. And this particular trading account will be showing the profit or the revenue for each contract and also the profit to be recognized during the current year. So I think we can just ignore the last contract here because no revenue, no cost to be recognized during this year. So we just consider the three contract, A01, B02, C03, and also our figures here will be in million of shillings. So we start with the revenue to be recognized during that year. So we have computed that revenue here. So we have 117, we have 570, we have 415.2, and then to this we less cost. We can just refer to that as cost of sales. So here we have 120, here we have 408, and here we have 483.6. And then from there, what we get here is the profit, all loss to be to be recognized during that year, as far as each contract is concerned. So let's compute this. So for the first contract here, we have -3, which is a loss. What about the other one? We have a profit of 570 minus 408, which is giving us 162, a profit. And the last one we have 415.2 minus 483.6. So this will give us a loss of 68.4. A loss of 68.4. So therefore that is first of all what is required as far as that part is concerned. You are required to determine that particular revenue and the cost, and automatically now we compute the profit or loss now to be to be recognized. And then from there we require now to prepare the income statement extract. The income statement, this is now for the company which is Mijengo. Remember the trading account which I have prepared here, this is a trading account which has been prepared to determine the profit or loss for each contract, contract. But in this case, the income statement will be prepared to determine the profit or loss of this company during this year. So income statement extract. This is not for individual construction contract, but now prepared to determine the performance of the company during the current year. During the current year. So how do we determine this, or how do we prepare this? First of all, we start by recording the profit or the loss recognized as far as each construction contract is concerned. So remember in our case here we have 3 construction contract, A01, B02, C03. So from the first construction contract, there was a loss. From the other one, B02, there was a profit of 162. And finally, we have a loss of 68.4. So, and then we get now the net amount, which now will be an income to this company. So we have what? We have 162 minus 3 minus 68.4. So that will give us 90.6, which is now like the total income. And then now to this, we less what? Expenses. We less what? Expenses. Expenses. Now, which expenses do we less here? We are lessing expenses which are general. And basically, the general expenses is now what you're given as the administrative expenses. So we are given the administrative expenses for the first contract, which is 1.5, the other one 15, the other one 2.5. So the total administrative cost, this will be 4 plus 15, which will be what? Which will be 19. So which will be 19. So, and then what we get is the profit for the year. The profit for the year for this company. So that is a profit now which our company made during that year. 90.6 minus 19, which will give us 71 point what? 0.6. Yes, so that is it. That what was required as far as the Roman 2 of that question was concerned. And these are obviously the items which were to give you now the 3 marks there. So finally, we are required to prepare an extract of a statement of financial position. And here I've said what the examiner was requiring is you determine something called the contract asset or the contract what? Liability. The contract asset or the contract what? Liability. So let's have that here. Roman 3, a statement of financial position extract. Showing what? Contract asset stroke what? Stroke liability. Stroke liability, and we're going to do this as far as our 4 contracts are concerned. So we have the first contract, which is A01, B02, C03, and then we also have D04. Yes, so how do we determine the contract asset or liability? So in this case, one, we have said we take the cost incurred to date, cost incurred to date, and we have the cost incurred to date from the information we have there. So here we have 180, we have 480, we have 963.6, and here we have 33.6. So to this, then we have said we add or minus the profit or the loss recognized during that year. So when we have that information here, for this, the first contract, there was a loss which was recognized of 3 million. A loss, we less it, but a profit we add. Then here we have a profit of this one, we add. Then here we have a loss of 68.4. That is a loss. So as far as the last contract is concerned, there was no profit or loss which was recognized. And finally, to this I've said we less amount invoiced and received. Amount invoiced and received. And we have said the amount invoiced and received is what is known in our question as payment on account. Payment on what? On account. The payment on account for the first contract here is 156. This one we less it. Then here we have 780. We less it. Then here we have what? We have 918. We less it. And here we have what? We have 24. We have 24. Yes. So what then we need to do is to determine now the contract asset stroke what? Stroke liability. So a positive figure is a contract asset, a negative figure is a contract what? Liability. So let's start with the first contract. We have 180 minus 3 minus 156. That will give us 21, which is a contract asset. And then we have 480 plus 162 minus 780, which will give us negative 138, which is a contract liability. And then the other contract we have 963.6 plus 68.4 minus 918, which will give us positive 114. And finally here, what do we have? We have 33.6 minus 24 minus 24, which will give us what? 96, which will give us 96. And I think equally we can determine the net amount here. So we add all this, we determine whether from this four contract, whether we have a contract asset or a contract what? Liability, by adding all this. So you have 9.6 plus 114 plus 21 minus 138. Yes, so in that case, we get a positive figure of 6.6 million, which automatically is a contract what? Asset. And that will be taken to the statement of financial position of this company as what? As an asset. As what? As an asset. So that is it, that what was required as far as that particular question is concerned. And equally that what you need to know as far as the construction contract are what? Are concerned. So therefore that brings us to the end of our lesson. Hi Rana, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, a lecturer for financial reporting and analysis. So in this class, I want us we start with topic number 2. And as far as this particular topic is concerned, we're going to discuss a number of issues. One, we're going to look on the principles for recognizing revenue as set out under IFRS 15. We're going to look on how a company, or basically how an entity should recognize revenue as far as various contracts with customers are concerned, e.g. hire purchase, e.g. consignment, sales, construction, contract. Also, we are going to look on the effect of changes in exchange rate, or basically how an entity should account for the changes in the exchange rate. And finally, we are going to look on the borrowing cost. What is the borrowing cost? How the borrowing cost is accounted for at the IAS 2023, that is International Accounting Standard number 23. So therefore, you're going to look on those three areas: how revenue is recognized at IFRS 15, accounting for changes in the exchange rate, and also borrowing cost at the IAS 23. So I want us to start with the first subtopic, which is all about revenue recognition at the IFRS 15. First of all, it is important to note that IFRS 15, this is a new accounting standard which was issued back in 2018, and it was issued by the International Accounting Standard Board to replace two standards. That is the International Accounting Standard number 18, which used to provide some principles regarding revenue recognition. So that particular standard has been scrapped. That is the International Accounting Standard number 18, and IFRS 15 superseded, or actually replaced now IAS 11, which used to provide some principles regarding how to account for construction contract. So therefore, first of all, we can say that IFRS 15 Yes, so therefore that is the first thing which is very, very important for you to note, that this is a new standard which was issued by the International Accounting Standard Board. So International Accounting Standard Board, basically this is a body which is in charge of coming up, formulating now the accounting standard. So it issued this standard back in the year 2018 to replace two standards. So mean that these two standards, that is International Accounting Standard number 18 and also International Accounting Standard number 11, this standard currently are no longer applicable, simply because they have been superseded. They have been replaced now by by IFRS 15. Now, what is the main objective of this particular standard here? The main objective of International Financial Reporting Standard number 15 is to set out the principles and also the rules to be followed by a company, or basically by an entity, when recognizing revenue from contract with customers. And therefore, what is expected of us here is to know how a company or how an entity should recognize revenue from various contract with with customers. We're going to see later on how the revenue should be or how revenue arising from various contracts, like hire purchase, like what if as a consignment, like what if as a construction, how it should be recognized as provided by by IFRS 15. And therefore, this particular standard here, that is IFRS 15, requires an entity to recognize revenue once the entity has transferred the control of the asset to the customer. Basically, what that means is that once a company has entered into a contract with a customer, and that company should supply some goods now to that particular customer, that company should only recognize revenue once the control of the goods have been transferred. What is the control of the goods? When we talk about the control, we are talking of the ability to direct the use of the goods, or the ability to direct the use of the asset, and also the customer is obtaining substantially all the benefits associated with such an asset. And therefore, this is quite different from what IAS 18 was requiring, because the previous standard on revenue recognition, International Accounting Standard number 18, was requiring an entity to recognize revenue once the entity transfer the risk and rewards associated with the goods and services to who? To a customer. In which case, we are saying that here this new standard requires revenue only to be recognized once the control of the goods or even assets have been transferred to the customer. So therefore, here we can say that IFRS 15 set out rules for revenue recognition based on transfer of control over goods, or based on transfer of control to a customer from the entity. From what? From the entity which is selling goods or services. So basically, what that means is that revenue here should be recognized. Once an entity has done has transferred the control of the goods or services now to who? To the customer. So that is now the rule which has been set out under this particular standard. But remember, what you have said is that the previous standard on revenue recognition, that is IAS 18, was requiring now an entity to recognize revenue once the entity transferred the risk and reward associated with the goods or services, or even now the asset. And therefore, here you can see there is a slight difference, or basically there is difference between the previous standard on revenue recognition and the new standard. Then from there, it is important here we define what is control. What is control? What do you mean by transferring the control of the goods or even the asset to the customer? When talk about the control, I would say that this is the ability of the customer to direct now the use, to direct how that particular asset or how those particular goods now will be used. And also number two, the customer is obtaining all the benefits associated with those particular goods or associated with that particular what? Asset. So once now the customer has obtained the control, that is the only time the entity should be able to recognize what? Revenue. So therefore we can say that control here, control is that particular what? Is that ability. Control is the ability, ability to control, and obtain all benefits, associated with the goods or assets. All what? Assets. So therefore, control is that particular ability to do what? To control. In this case, I've said to control is basically what? Ability to direct the use. To direct the use. So if the customer is in a position to direct how the asset will be used, also the customer is obtaining all the benefits associated with the goods and services, the entity which is selling such goods, the entity which is selling that particular asset, then should go ahead and do what? And actually recognize the revenue. Now, on the other hand, it is also important for us to define what is benefits. When we talk about obtaining the benefits of goods, or basically obtaining the benefits of an asset, basically what this means is that that particular customer is in a position to do what? For example, to use that asset, maybe in terms of adding value to other what? Asset. The customer is in a position to use that particular asset, maybe to do what? For example, to settle certain liabilities, to reduce what? The expenses. Equally, the customer can be able to use that particular asset to secure a loan. The customer can be able to use that particular asset as a collateral security to do what? To obtain a loan from what? From a bank. So therefore here we can say that we can talk over benefits of goods or what? Asset. Benefit of goods or assets. And we can first of all define what is the benefit, and we say that benefit, this is cash flows, associated with goods, all what? Assets, associated with what? Goods and asset. And then we also say that a customer obtains benefit of goods, in the following ways. Obtain benefit of goods if, number one, that particular customer is using the asset to produce goods or services. So if the customer is using that particular asset to produce some goods and services, so in this case we say that the customer has been able to obtain what? The benefit associated with those particular goods, or basically what? Asset. All asset. Number two is that a customer obtain the benefit of goods or asset if that customer can do what? Can pledge that particular what? Asset as a collateral security, in obtaining a loan. So if the customer can be able to use that particular asset as a collateral security whenever the customer is borrowing a loan from the bank, in such a case, still we say the customer has been able to do what? To obtain the benefits of the goods. Number three is that a customer also obtain the benefit of the asset once the customer is holding the asset. In other terms, once the possession of the asset has already been transferred now to the customer, and the customer is in possession, the customer is holding that particular asset, then we say the customer has also been able to obtain what? has been able to obtain the benefits of what? Of that particular asset. And number 4, we say that a customer has obtained the benefit of an asset if the customer is using the asset to do what? To add value to another asset. To add value to another asset. And also number 5, we say that a customer has obtained benefit of a good or asset if the customer still is using the asset to do what? To reduce expenses, or settle what? Or settle liabilities. Or settle what? Liabilities. So in all these particular cases here, basically we say that the customer has been able to obtain what? The benefit of goods. So therefore, it is very, very important here to note that under this particular standard IFRS 15, a company or an entity should only recognize revenue if that particular entity has transferred now the control of those particular goods or assets, meaning that the customer to whom the control has been transferred to is in a position to direct how that particular asset will be used. Or number 2, the customer is obtaining what? The substantial what? Benefits associated with that particular what? Asset. In this case, we have talked about the various ways in terms of how now a customer may be obtaining what? Benefits associated with the asset, like using the asset to produce some goods or services, or pledging the asset as a collateral security in securing a loan, or holding an asset. The customer has been able to obtain the possession of the goods, or the customer is using that particular asset in terms of adding some value to other assets, and that particular customer is also using that particular asset to do what? To reduce some expenses which are incurred by him, or to settle certain what? Liabilities. Settle certain liabilities. So there was a question which was examined on this in the sitting of December 2023. So I can just give that here as an assignment. December 2023. It was question number 1. So you check on this particular question, you'll be able to see that question which was asking about various ways in terms of how a customer obtain the benefit of asset. The benefit of asset. What the examiner was requiring, you give these particular 5 ways in terms of how now a customer obtain the benefit of what? The benefit of the asset. So that is the first thing you need to know here. Then from there, let's proceed and look on something to do with the scope of IFRS 15. Scope of IFRS 15. IFRS 15. So when talk about now the scope here, basically we are talking of those particular contract with the customers whereby this particular standard apply. IFRS 15 applies to which contract with the customers. So in this case, we say that IFRS 15 will apply to all contract with customers. To all contract with customers, e.g. hire purchase, e.g. what refers the consignment sales, e.g. construction contract. But IFRS 15 do not apply in certain contract with customers, such as leases, such as what refers the insurance contract, and so on. So therefore, we can say that IFRS 15 applies to all contract with customers, all contract with customers, all contract with customers, e.g. hire purchase, e.g. hire purchase, consignment sales or consignment contract, consignment sales, construction contract, etc. etc. So equally we can say that the following contract with customers, the following contract with the customers do not fall within the scope of IFRS 15. Do not fall within the scope of IFRS 15. What does that mean? That the following contract with customers do not fall within the scope of IFRS 15. So we are talking of those particular contracts with customers which should not be accounted for, or the revenue from such a contract with customers should not be recognized in accordance with the principles, with the rules laid down at the IFRS what? 15. So which are those contracts which do not fall within the scope of IFRS 15? Number one, we have leases. Leases, this one should be accounted for in accordance with IFRS 16. Number two, we have insurance contract. Insurance contract, which should be accounted for in accordance with IFRS 4. We also have contracts such as financial instruments, which equally should be accounted for in accordance with IFRS 9. In accordance with IFRS what? 9. So therefore, all these particular contract with the customers do not fall within the scope of IFRS 15. Any revenue, any income coming from this particular contract should not be recognized in accordance with what? In accordance with the IFRS what? 15, but should be recognized in accordance now with the specific what? Standard. If something like leases, that should be the revenue coming from such contract should be accounted for in accordance with what? IFRS 15. There is a topic we did as far as that is concerned, or basically we covered this topic, subtopic in topic number 1. Then any revenue arising from insurance contract should be recognized in accordance with what? IFRS 4. And financial instrument, which also we covered as a subtopic in topic 1, any revenue coming from that should also be recognized and also accounted for in accordance with what? In accordance with IFRS 9. So therefore, it is important to note what is the scope. This IFRS 15 applies to which contract with customers? It applies to those particular contracts which you have mentioned there, e.g. hire purchase, consignment, sales, construction contract, and so on. Then from there, I want us to proceed and look on how now the revenue from contract with customers should be recognized in accordance with IFRS 15, though there is something we have mentioned as far as that is concerned. And also we look on something known as the 5-step model set out by IFRS 15. IFRS 15 has come up or has given a model which include 5 steps to be followed by any entity or basically by a company for the company to be able to recognize what? Contract with what? With customers. So let's next look, we look on that. So we have the revenue recognition, or we can just talk of recognition criteria. Recognition criteria. We are talking of the revenue recognition criteria as set out under IFRS 15 and 5 steps model. 5 steps model. Already we have mentioned something to do with the revenue recognition criteria set out under IFRS 15. We have said that here a company should only recognize revenue from contract with customers once the entity supplying the goods or services transfers the control of the goods, transfer the control of what? Of assets. So therefore, we can just summarize that here and we say revenue should be recognized based on transfer of control of goods or services and not based on transfer of risks and rewards as it was required under IAS what 18. Previously, a company was recognizing revenue from contract with customers once the company transferred what the risk and what the risk and rewards associated with the goods or what services. But under the new standard here, we are saying revenue should only be recognized once an entity transfer what the control of the goods or what services. And actually, we have defined what is a control. We have said the control means that the customer to whom the goods have been transferred to is in a position to direct how those particular goods will be used, and also that customer is obtaining all benefits associated with those particular goods, associated with those particular what assets. So that is how revenue should be recognized in accordance with IFRS 15. Now, this particular standard here also, we have said it has set out a 5-step model to be followed in recognizing of what of revenue. So therefore, we can say that IFRS 15 set out the 5-step model, 5 steps model to be recognized, to be followed, that is, to be followed by an entity in recognizing revenue. In recognizing revenue. So which are those particular 5 steps which a company should follow for that company to be able to do what? To recognize revenue from contract with customers. So the first step is to identify the contract with customer. So that is the first thing. So that an entity, we need to identify the contract with customers. The contract with who? With customers. So in this case, basically a contract with a customer or customers. This is basically an agreement between an entity and a customer that an entity will supply some goods, or an entity will sell some or will provide certain services or sell an asset to a customer. So once that contract has been entered into, the two parties have been committed to that particular contract. The entity is committed in terms of supplying goods, in terms of providing services, and the customer is committed in terms of paying the purchase consideration. Then in that case, we say a contract has been what? Entered into. So therefore, that is the first step or the first thing which need to be done by an entity for the entity to be able to do what? To recognize revenue from contract with customer. Identify the contract with who? With the customer. Number 2 is that the entity will then need to proceed and identify the performance obligation. The performance obligation. We need to proceed and do what? Identify the performance what? Obligation in the contract. In the contract. So what do you mean by performance obligation? Performance obligation here, we are talking of what is expected of the entity in such a contract. So automatically, once an entity enters into a contract with a customer, the obligation of the entity entails supplying some goods, entails providing certain services, or even entails selling an asset. So that is the obligation of what? Of the entity. So the entity will need to determine what is its specific obligation as far as that particular contract with the customer is what? Is concerned. So then the other step, number 3, is that the entity will then need to proceed and determine something called the transaction price. Transaction price. transaction price as far as that particular contract is what is concerned. Determine the transaction price. So in this case, when we talk about the transaction price, we are talking of the purchase consideration which is to be paid by a customer once the goods are supplied to a customer or once services are provided to a customer. So what is the customer expected to pay in that particular what? In that particular contract. So once the entity has been able to do that, then step number 4 is that the entity will need to proceed and allocate the transaction price. The transaction price to performance obligation. To performance what? Obligation. To performance obligation. What that means is that the entity allocate the transaction price to the performance obligation. Mostly, this happens whereby an entity which has entered into a contract with a customer, that entity is expected maybe to perform some obligations, which, for example, can take a substantial period of time for them to be completed. For example, in a construction contract, a company may secure a construction contract with a customer, and maybe that construction contract will take a period of 3 years for it to be completed. So the contract price now which is to be paid must then be allocated to the period or to the 3 years which now an entity will have to take for it to be able to do what? To complete that particular contract with who? With customer. So therefore, step number 4 we are saying here is that the entity should proceed and do what? Allocate the transaction price to the performance what? Obligation. And finally, which is now step number 5. Step number 5 is that the entity now will have to recognize what? Will have to recognize the revenue obligation has been what? Satisfied. So therefore, step number 5, we can say that this entails doing what? This entails recognizing revenue, or we can talk of recognition of revenue. Recognition of revenue as performance obligation, as performance obligation is satisfied. As performance obligation is what? Is satisfied. So that is the last step here. The entity to do what? To recognize now the revenue, but that revenue can only be recognized once the performance obligation has been what? Satisfied. Remember, we have said performance obligation. This one entails doing what? This one entails supplying goods. Supplying goods. So once an entity has supplied now the good to the customer, so in such a case we say the performance obligation has been satisfied, or the performance obligation will entail providing services. Providing what? Services. So once those particular services have been provided, then what the entity will do is basically to go ahead and do what? Recognize now the revenue. So therefore, those are the 5 steps which need to be followed by an entity as set out under IFRS 15, and basically refer to this as 5-step model, 5-step model for revenue recognition. Equally, there was a question which was tested on this. There was a question which was tested on this. It was basically asking about the steps, the 5-step model. You actually describe the 5-step model as set out under IFRS 15. So also I give this particular question here as an assignment. This was a question in the sitting of November 2019, and this was question 3A. So that question was requiring the candidates to do what? To describe the 5-step model followed by an entity in recognizing revenue, and that question had 10 marks because you had to explain those 5 steps. 5 steps set out under IFRS 15. So that basically the other thing which is important for you to know as far as IFRS 15 is what? Is a concern. Now, In the introduction part, I said that IFRS 15 has set out now the rules to be followed by the entity in recognizing revenue from various contract with what? With customers. As per the syllabus, we need to look on the various rules to be followed by an entity when the entity is recognizing revenue from contract with customers, and those contracts include what? Hire purchase, include something called the consignment, and then include something known as what? The construction contract. I want us to start by looking on how revenue is recognized at the hire purchase contract and the hire purchase contract. So we can look on the application of IFRS 15 in the following contract with customers. Application of IFRS 15. IFRS 15. And we start by looking on how this particular standard applies. Number one, in what we refer as hire purchase contract. Hire purchase contract. So first of all, when we talk about a hire purchase contract, this is a contract between an entity or the owner of an asset and another person who is called the hirer, whereby the hirer or the owner of the asset transfer the possession of the goods now to the hirer, and the hirer agree to pay the price on installment basis. And also on the other hand, we say that the hirer has the option to do what? To hire the goods or to purchase the goods. To purchase what? The goods. So even before you look on how the revenue should be recognized from this particular contract, we can just say that HP contract, hire purchase contract, is a contract, or we can just say HP is a contract. HP hire purchase is a contract. Where the owner of the goods, transfer a possession of goods to hirer. That is the other party in a hire purchase contract, to hirer, and the hirer pays the price on installment basis. What that means is that in a hire purchase contract, the hirer here will always pay the price on installment basis. But on the other hand, we are saying here in hire purchase, the owner of the asset only transfer the possession. If you buy some goods through hire purchase, that means that the possession of the goods and not the ownership. The possession of the goods now will be transferred to you. You commit yourself to pay the price on installment basis, and the ownership of the goods will only pass to you once you have exercised the option to purchase. You exercise the option to purchase the goods once you clear all the installments. Once you clear all the installments, that is the only time you have exercised the option to do what? To purchase. So therefore, according to this particular standard here, that is IFRS 15, revenue arising from hire purchase contract should only be recognized once the hirer has exercised the option to purchase the goods. So the customer exercised the option to purchase the goods once he has cleared all the installment. Once he has cleared all the installment, that's the only time an entity should recognize what? A contract, should recognize revenue from such what? From such a contract. And therefore, in this case, we can say revenue from this contract, is only recognized when the control of goods is transferred transferred to the customer. In this case, remember the customer is the person we are referring to as the hirer. So the revenue here should be recognized when the control of the goods is transferred to the customer. So in this case, we have said the control of the goods now is the control of the goods is transferred to the customer once the customer exercises the option to purchase. So in this case, we say control is transferred when the customer exercise option to do what? To buy the goods. Equally, we have said that the customer exercises the option to buy the goods once the customer pay all the installment. Pay the installment, i.e. Pays all installment. Pays all what? Installment. That is very, very important, that once an entity sells some goods through hire purchase, that entity should not recognize revenue until the customer has exercised the option to do what? To purchase. Exercising the option to purchase means that the customer has cleared all the installment. And the reason why that is the case is because once the customer has paid a number of installments, not all of them, and maybe he fails to pay some of the installment, then the owner of the asset can do what? Can repossess back those particular goods. And therefore, if the revenue was recognized, you can see then an entity may need to reverse that revenue which was already what? Recognized, because now the goods have been what? Have been recovered, have been repossessed. So therefore, that is now the rules set out at the IFRS 15 as far as the revenue recognition from this particular contract is what is concerned. Let's proceed and look on how revenue should be recognized at the other contract with the customer. Yes, number 2, let's look on the application of IFRS 15 in another contract with the customer, which is known as consignment sales. Consignment sales. So what do you mean by consignment sales? When talk about the consignment sales, mostly this applies now to the sale of motor vehicles, whereby manufacturers of motor vehicles, maybe you can take a good example of Toyota Kenya and so on, manufacture a number of what? Motor vehicles. They deliver those particular motor vehicles now to the various car dealers, who should then look for customers and then sell those particular cars. So now a question arises here. When should the manufacturer, for example, Toyota Kenya, recognize now the revenue? Is it the time when a number of motor vehicles are transferred to a car dealer? Or is it the time when the car dealer is able to get a customer and sell the car? So now IFRS 15 comes in here and basically has provided some rules regarding when the revenue should be recognized in such what? In such a sales arrangement. In such a sales what? Arrangement. But even before we look on how the revenue should be recognized, so it is important, first of all, we define what is a consignment. Consignment. And basically in this case, we have said that this is a contract where the consigner in this case I've said is manufacturer, and I think we can just use a good example of what? Toyota Kenya. Toyota Kenya is basically a manufacturer of various motor vehicles. The consigner do what? Transfers goods to a consignee. So in this case, I've said that when we talk about now the consignee, we are talking of the car dealers. Car dealers, these are those companies which sells motor vehicles to its customers, transfers goods now to consignee, who holds them for sale, for what? For sale. Who holds them for sale? To the end user, or basically now to the customer. Now, in this case, we are saying a question arises here. When should this consignor here recognize the revenue? Is it the time he has transferred the goods now to the consignee? Or is it the time the consignee has been able to do what? To sell the goods now to the customer. It is also important, even before you look on the what IFRS 15 says about the revenue recognition there, it is also important to note that these two parties here, that is the consignor, for example, Toyota Kenya, once they deliver various cars now to the car dealers, always there is an agreement that if the consignee is not able to sell those particular cars within a given period of time, maybe six months or 3 months, so what happens is that those particular cars are repossessed by the manufacturer. Are repossessed by who? By the manufacturer. So therefore, according to this particular standard here, IFRS 15, the consignor, who is now the manufacturer, in our case, the manufacturer of motor vehicle, should only recognize revenue once the control of the goods have been transferred to the end user. To the end user, or the end user in our case is who? Is the customer. So the moment now the consignee, the car dealer has been able to get a customer and has gone ahead and sold those particular cars now to the customer, that is the only time the consignor should be able to do what? To recognize revenue. To recognize what? Revenue. So in this case, we say that IFRS 15 requires revenue in such a contract to be recognized when the control of the goods is transferred to end user. The end user in this case we have said is the customer. By who? By consignee. By the consignee. So that means that once the consignee, for example, a car dealer is able to secure or is able to get a customer, and basically the consignee has gone further and basically sold those particular goods or those particular cars now to the customer. That is the only time now the manufacturer should be able to do what? Should be able to recognize that, as what? As a revenue. But until such time, the manufacturer or basically the consignor should continue accounting for those goods which have been transferred to the consignee as part of the inventory. As part of what? Of the inventory. So equally, I think it is important for us to mention that, and we say until goods are sold by the consignee, until goods are sold by consignee, comma, the consignor should recognize them as part of inventory. Should recognize them as part of what? Of the inventory. So that's basically what is set out regarding revenue recognition under what refers as consignment sales, under what refers what? IFRS 15. So that is very, very important. So I want us, we stop at that point. Once we come back in the next lesson, we are going to look on the application of IFRS 15 in something called the construction contract. So see you in the next lesson. Hi students, welcome to another session of Manifested online classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us to look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us to go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued lends, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 and $115,300 respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you are told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1, and then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account, that is on 15th of January 2022. 22. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad marketing account showing the profit and loss. Number 2, Mzuri Brad marketing account showing the profit or loss. And part C, statement of profit or loss for the year which ended 31st of December 2021. And finally, statement of financial position. So as far as the first two accounts are required, part A and part B, whereby you're required to prepare the marketing account of the two coffee brands. We're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee brands. And what we are going to do, we are going to take now the sales the sales of the two coffee brand, which is given the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1, and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%. Then we are going to less now the expenses, specifically relating to those two coffee brands. So we start with part A. Part A of that particular question. We are required to prepare a Safi brand marketing account. Which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales. The sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was $175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate these into Kenyan shillings. I've said we're going to use now the exchange rate when the money was remitted out to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with with 100, so that we get the final figure here. So let's get the final figure. So this is 175,000. 175,000 then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these two coffee brands, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we less now the the expenses. So first of all, we have now to deduct amount due to members. Amount due to members. And basically in this case, we have said the amount due to members is 80%. amount due to members. That amount due to members, in our case, we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17,500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17,500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item in the trial balance, we have the expenses associated with marketing and selling a Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860. And then we have processing wages, which is an amount of 900. Yes, an amount of 900. So whatever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300. But this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what you have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. Marketing expenses, an amount of 150. And then we have processing materials. Processing materials, an amount of 320. And then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this what the cooperative society was supposed to pay to the members, it had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the for the entire cooperative society. Remember what you have prepared in part A. Part B is prepared to determine the profit from marketing and selling the 2 coffee brand. So part C, we are required to prepare a statement of profit or loss, statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have 2 columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. With the expenses, automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before we go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee brands on behalf of the members, we know that from marketing of the 2 coffee brands, there was a profit of 1,100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee brand Safi, which is a figure of what? Of 1,100, and then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment. Dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, this is like the retained profit at the start of the year, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society. And this entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft. All those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans. Members or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1,100 plus 1806 plus 470 plus 300 plus 35 890 35 890. Okay, yes, that will give us the total incomes of 39 566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of this cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as the staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, we have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid. It's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these 2 coffee brand, Safi and Muzuri. And because we captured those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Muzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges. Bank charges, an amount of how much? An amount of 200. We have bank interest. Bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education. That is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. Printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that, we have members education. Members education. Members education is a figure of 1,500. And then below that, we have entertainment. Entertainment. Entertainment is a figure of 50. And then next and finally, we have the legal fees. The legal fees, which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were six. So by recording those particular items of incomes and the expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So you prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session, as far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that, we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that, we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6,550. Then below that, we have receivables. We have receivables from members, which is a figure of 2,960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other coffee brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore, to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26,550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit, which is a figure of 64,650. Yes, and then from there we have various items of reserves, starting with the just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you're told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We are going to compute that figure. And still we have appropriation account. Appropriation account, these accounts still, or these figures still need to be adjusted because what you're given there is the appropriation account at the start, which is what? Which is 50. To this, we should add the profit for the year. The profit for the year, remember, is 14,190. But equally, we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190. And we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,578 578 plus 64 650 plus 900,000 which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number 1, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee bread. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee brand is concerned. If you add those, the amount from Safi brand marketing account, Mzuri a brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee brand. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability here. I think with that what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent, which is 470. Below that we have salary provision, provision 4950. And then down there we have salary creditors, which is a figure of 3410. And then we also have bank OD, bank overdraft of 6150. Yes, so I think we have recorded all items of liabilities. None of the item which you have not recorded. Yes. So what we just need to do here is now we get the total. Equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 60,86 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 61 330. 61 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. The items to be marked, but definitely that particular statement of financial position, as you can see, there are so many entries, so many what entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic.
Greetings, candidates, and welcome to the lesson. We are going to study the internally generated funds and the externally generated funds under the topic, the financing decision. These are two broad categories of financing sources for enterprises. And understanding the distinctions between the internally generated funds and the externally generated types of funds is crucial for effective financial management. So we are going in our today's lesson to do a comparison between internally generated funds and externally generated funds. That's what we'll study in our today's lesson. Externally generated funds. We'll first of all look at the internally generated funds. Now, our distinction will be based on certain features or characteristics like the source. Let me put it down here. Source. What is the source of internally generated funds or origin? Candidates, internally generated funds, as the name suggests, originate from within a company's own operations and activities, and is primarily composed of retained earnings, accumulated reserves, depreciation funds, and so on. These funds originate from companies' own operations. The origin, the source originates from companies' own operations or activities. Source. I've given examples. The retained earnings, accumulated reserves, retained reserves, accumulated depreciation funds, and so on. We can also distinguish internally generated funds from externally generated funds on the basis of ownership. Ownership. Now, internally generated funds do not dilute the control ownership or ownership control of existing shareholders. Do not dilute the ownership control. These internally generated funds do not dilute ownership control. But the externally generated funds, they dilute the ownership control. They do what? They dilute the ownership control. Internally generated funds originates from companies' own operations and activities, but externally generated funds originate from outside. They come from outside sources, like debt financing, like equity financing, and various other capital sources. But internally generated funds, these are funds that originate from within the company's operations and activities. Number two, ownership. Internally generated funds do not dilute ownership control, whereas externally generated funds dilute ownership control. We can also distinguish the two on the basis of cost. Cost. And when we are referring to cost, we can mention something on the cost structure. Generally, internally generated funds do not involve explicit costs like interest payments, like dividends, and so on. They do not involve explicit costs. Do not involve explicit costs like interest payments, dividend payments, and so on. But externally generated funds involve explicit costs like interest, like dividends, and so on. Cost structure. 4, flexibility. Now, internally generated funds as a source, this source of funding, this source of finances from within the company provides greater flexibility in decision making. Provides greater flexibility in decision making. Provides greater flexibility in decision making. Why? Because the company is not bound by external debt covenants or the expectations of external investors. The company is flexible. If the company wants to use retained earnings, does not need approval from external people or providers. So it's more flexible. These sources, internally generated funds, these sources of funds are generally flexible compared to external sources. Five, stability, financial stability. Now, relying on internally generated funds, when a company relies, let me put it this way, when a company relies on internally generated funds, such a company enhances financial stability, especially during economic downturns. Why? Because the company is less dependent on external sources, is less dependent on the external markets for financing. It's more, provides more stability. Okay? Do you understand? Relying on internal funds enhances financial stability. Enhances financial stability. Do you understand? As you are going to see, as you compare the two, let me have another column here for comparison purposes. This is a column for internally generated funds. You can have another one here for externally generated funds. Number one, on the basis of the source, distinguishing the two, internally generated funds originate from companies' own operations. For externally generated funds, these funds originate from outside the company. From outside, like debt financing, hire purchase, and so on. These funds are originated from outside, and they comprise funds raised through loans, bonds, equity issuance, venture capital, private equity, and other external financing mechanisms. We also distinguished the two based on ownership, and we stated here that internally generated funds do not dilute ownership control. But externally generated funds often involve external investors or creditors, leading to potential dilution of ownership control. This one leads to dilution of ownership control, because new investors are brought into the company, and the existing company, the existing shareholders do not enjoy a monopoly in ownership. The ownership is now shared once new investors are brought on board. Do you understand? Number three, we saw here that internally generated funds do not involve explicit costs, but external funds typically come with explicit costs, such as interest payments for debt or dividends for equity. These funds come with explicit costs. I've mentioned interest payments, dividend payments, and so on. The other distinction is based on flexibility. We saw that Internally generated funds provide greater flexibility in decision making. Provide greater flexibility in decision making. But for externally generated funds, there are constraints. External financing may come with specific terms and conditions, may come with covenants, may come with expectations, and companies may have to adhere to certain constraints imposed by creditors or investors. External generated funds come with constraints, There are decision constraints. External financing may come with specific terms and conditions. Terms, conditions come with terms, conditions, covenants, and so on. There is no flexibility in decision making. A company is not free to make decisions when involving external investors, like debt covenants, where maybe the assets of the company are charged on the basis of the debts. A company is not free. So here there is less or no flexibility. Little flexibility, no flexibility compared to internally generated funds. Do you understand? Then there is the aspect of stability. Internally generated funds enhances financial stability, But for externally generated funds, there is what we call market dependency. The company depends hugely on the market. Companies that rely heavily on external financing may face challenges during economic downturns or in volatile markets, such as where external funds are subject to market conditions and investor sentiments. Do you understand? So these are four points to illustrate the difference between externally generated funds and internally generated funds. And when deciding on whether to opt for internally generated funds or the externally generated funds, there are other considerations that the company can put into that could consider. There are considerations that the company has to look at, like risk and return. The decision to use internal or external funds may depend on the risk tolerance of the company and the return expectations of the investors. And we know that external financing may offer higher leverage, but also provides higher risks and costs. Another factor to consider when selecting either between internally generated funds or externally generated funds is the growth and expansion. For substantial growth initiatives or capital-intensive projects, companies may resort to a combination of internal and external financing. Why? In order to meet their funding requirements. So we discussed 4 points that has helped us understand the distinction between internally generated funds and externally generated funds. The first distinction is based on the source. You say that internally generated funds originate from the company's own operations and activities, but externally generated funds are originated from outside the company. Number 2, the second distinction is based on ownership. Internally generated funds do not dilute ownership control whereas external generated funds dilute ownership control. Point number 3 was based on the cost. We saw that the internally generated funds do not involve explicit costs, but externally generated funds come with explicit costs like interest payments and dividend payments. Number 4, fourth distinction is based on flexibility. Internally generated funds provide greater flexibility in decision making, but there are constraints when it comes to externally generated funds. Then lastly, the first point distinction is based on stability. Internally generated funds enhances financial stability, whereas the externally generated funds depend on market conditions. There is market dependency. Companies relying heavily on external financing may face challenges during economic downturns or in volatile markets, because such funds are subject to market conditions and investor sentiments. That is the end of today's lesson. Allow me to read 3 questions for your revision. 1. What are the advantages and disadvantages of relying on internally generated funds as a source of financing for enterprises? Number 2, how can enterprises effectively tap into externally generated funds, and what are the various external sources available to businesses for financing? 3, in what situations would a company prefer internal financing over external financing, and vice versa, considering the impact on business operations and financial stability? Thank you for attending the lesson. Bye.
Hello class, welcome to lesson 3 of topic number 5, which is share capital. Share capital. In this lesson 3, we will look at the prospectus. We shall look at the company's prospectus or prospectuses. And in respect of the prospectus, we will define the prospectus, look at the essentials of a prospectus. Then we will look at the contents of a prospectus. Then we will look at criminal liability arising out of the issue of prospectuses. Then I will also look at the civil liability arising out of the issue of prospectuses. Then I also intend to look at the purchase of shares, the purchase of own shares by a company. Then finally, we shall look at payment of dividend and the dividend rules or rules relating to the payment of dividends by a company. So let's begin by where we want to describe or define a prospectus. Now, when you look at our act, that is the Companies Act of 2015, it does not give a very clear prescription or description of what a prospectus is. It talks about a prospectus, being a notice, being a circular, or any advertisement issued by a company, offering securities to the public, for subscription, offering securities to the public for subscription. So quite a number of words have been used to describe this document, that it is a prospectus, that it is a notice, it is a circular, it is an advertisement, should be an R there. It is an advertisement issued by a company offering securities to the public for subscription. Now, what we conclude is that there will be no specific format that this document, that is the prospectus, may take. That it could be in the form of a notice, it could be in the form of a circular, form of an advertisement. Simply put, no specific format that we expect of prospectuses to be taking, provided that it is a document containing those specific contents as we shall be discussing later on today. And then what it is doing, that this document is inviting for subscription. It is inviting the members of the public to subscribe for the securities of the company. So the test of what the prospectus is not much on the format of the document, but specifically what the document does. What the document does, that it is a document inviting for subscription, inviting the public to subscribe for the company shares, and that of its contents. That the contents and what the document does is the test of what a prospectus shall be. Now, there is this term that we are using here, the term offering securities of the company, offering securities of the company to the public for subscription. Now, the term offering, as used in this description, is not in its strict legal sense. In the strict legal sense, when you talk about the prospectus offering for subscription, you would imagine the issue of the shares or the prospectus being an offer for the company shares. It is actually not. It is an invitation to treat. It is inviting, the prospectus invites potential subscribers to make offers by making an application for the company shares. It is until when these applications are received, when the company makes an allotment, the offer by way of application is accepted by the company by allotting shares. So the prospectus in itself is an invitation to treat, not an offer. Though in this description, we are talking about the prospectus offering. So that use of this term offering is not in its strict sense. We are also making reference to this word public. And the question would be, does a prospectus have to make an invitation to the entire republic? Does it have to make an invitation to each and every person? Now, common law, by way of courts' decisions that we have received from courts, the suggestion is that the reference to the word public does not have to include everyone. That the invitation to the public will be sufficient even where a section of the public is targeted. So if we have a company issuing shares and the only places where this prospectus has been circulated is Nairobi, now the question will be, was that a public issue? And the idea is, since Nairobi is part of the general public in Kenya, then that is a public issue of the prospectus. Even a section of Nairobi residents receiving the prospectus, it would still qualify to be an issue targeting the public. So this document is taking no specific form. We are judging what it is by what it does and its contents, that it is issued inviting members of the public to subscribe for the company's securities such as shares. And then we look at the contents as we shall be discussing them later. Now, let's go to the essentials. When a prospectus is issued, there are specific things that it must come along with. There are specific things that the prospectus must demonstrate. The essentials of a prospectus. For instance, we are saying that all prospectuses must be dated. They must contain a date. They must indicate a date. And the idea is this date that shall be contained in the prospectus shall be assumed, shall be considered to be the date of issue of the prospectus. All prospectuses must be signed. All prospectuses must be signed. Now, one of the persons to sign the prospectus will be any person named as a director, any person named as a director by that prospectus must be signing the prospectus. The idea of them signing is considered to be them giving an authority or giving their consent for the prospectus to be issued, which is important. Any person or any expert who was issued a statement, So sometimes when you're issuing prospectuses, you may want to get some experts to give their opinion on certain matters. It could be about the evaluation of the company's assets. It could be about the prospects of the company's business. So when you get such experts giving statements about this prospectus, then you also get them to sign the prospectus, and particularly a copy of the opinion or the statement that they have endorsed. This endorsement or this signing is seen as giving consent to that statement being issued to the public for consumption. The other thing that will also be part of these prospectuses would be endorsements or attachments. Attachments to the prospectus. This could be any expert opinions or expert statements that have been given in relation to the issue of the prospectus. It could also be financial statements of this company issuing the prospectus. Then finally, we must also have a statement. We must have a statement issued. To the effect that a copy of the prospectus has been issued to the registrar. That a copy of the prospectus has been issued to the registrar. Now, this is the issuing of the copy of a prospectus to the registrar is a protective measure that the registrar's office is a public office that should receive this document for purposes of confirming, for purposes of ensuring that this document is compliant to the provisions of the law. So that if you are issuing a copy of the prospectus to the public, and we have a statement in the prospectus that says, we have also given this copy to the registrar, that the registrar has authorized the issuing or the sharing of this document to the public, then it inspires confidence to the public that this document that is being issued by this company in respect of the subscription of particular securities that they are issuing is a compliant document. So this should be some of the essentials we are expecting this prospectus to manifest. Now, I want to discuss the contents of the prospectus. Contents of the prospectus. Contents of the prospectus. Now, if you know why this document is being issued, then it becomes very easy to anticipate some of the contents or the contents that you expect to find in this document. We are issuing a document to the public to share with them all the necessary information that they need to enable them to make a decision on whether they are going to buy, they are going to invest, they are going to subscribe for the shares of this company or any other form of security that this company could be issuing. So imagine yourself as the investor, and we are issuing a document that should give you information sufficient enough to base your decision on whether you're investing or not. So question would be, what kind of information do you expect that we should share in that document? Now, part of the contents or part of the information that we should be sharing in this document will be information relating to the company itself. We shall also be sharing information relating to the management of the company. We shall also be sharing information relating to the securities that we are issuing, so that all these pieces of relevant information will be enough or will be consumed by the potential investor in determining whether they are going to invest in the securities that are issued by this company. So what are some of the things we're expecting to find? You expect that the prospectus will tell you something about the company's preliminary expenses. The prospectus will also talk to you about the remuneration of promoters. This prospectus should also tell you about any founders shares that have been issued to management. It should also tell you about the particulars. It should also tell you about the particulars of directors. So what are the names of these directors, addresses, including occupation. So what else do they do when they are not directing this company? This could be a good test for the experience and the exposure these directors have. You would also need information to do with the director's remuneration. The director's remuneration. So how much are they paid to manage this company? You would also give information about directors' share qualification. So does this company require their directors to take up some minimum number of shares as part of their directors' share qualification? It makes the directors part of the membership of the company. You may also have requirements relating to the securities themselves. So the rights conferred by the shares. So we are going to buy shares. What rights do these shares that you are issuing grant us? Opening and closing of subscription lists. So when can we start applying for these shares, and when will they close? They should also tell us about the minimum subscription. The minimum subscription. This is an amount out of the total amount of capital that the company wishes to raise. They will indicate the minimum amount that they must or they consider should be raised in this issue. That is the amount that the company is thinking would be good enough to have some working capital, good enough to meet any costs of this issue may have come with, any pre-incorporation, any preliminary expenses that may have been incurred. So they should also be stating this, the minimum subscription expected from this issue. It will also be important to be told about the auditors of the company, if any have been appointed, auditors of the company. We can also be told about any material contracts. We can also be told about any material contracts entered into matters relating to shares that have been issued otherwise than on a cash basis. Basically, what we are saying that this prospectus should be giving us information relating to who manages this company. What kind of shares are we buying? What prices? When do we start buying? What kind of rights are they giving us? Then the company itself. How long have you been doing business if less than 3 years? Have you entered into any material contracts that you think we should be disclosed in this prospectus that we should consider when investing, when purchasing the securities of this company? Basically, it is information good enough to enable a potential investor to base their decision on whether they are subscribing or not subscribing for the shares of this company. Now, the issuing of a prospectus, actually the preparation and the issuing of a prospectus, is subject to very strict rules, such that we have a lot of liability that has been created in relation to the issuing, preparation and the issuing of prospectuses to ensure that companies comply with these rules. There will actually be liability on the part of directors, part of experts, or any persons who have been named as directors in this prospectus for non-compliance with some of the requirements of the Act relating to the issue of the prospectus. It is that liability that I now want to discuss in relation to the issue of prospectuses. Let me begin with the criminal liability. Criminal liability relating to prospectus. Criminal liability relating to prospectuses, where we are saying that it is an offense to do what? So for certain things that we shall do relating to the issuing of prospectuses, the Companies Act considers them criminal, considers them an offense for which a fine shall be imposed on the defaulting officer of the company. For certain things that we may omit during the preparation and the issuing of the prospectus, the Companies Act considers them an offense by way of an omission for which a fine shall be imposed on the liable officer of the company. So I want us to consider some of these things that under the Companies Act are considered a criminal offense, either when done by the company or the company's responsible officers, or when not done in relation to the preparation and issuing of prospectuses. Now, we are talking about one, it being an offense to issue a prospectus, a copy of which has not been presented, to the registrar, a copy of which has not been presented to the registrar. This is just a legal expression to say you are not supposed to issue prospectuses when you have not given a copy of that prospectus to the registrar. So when the company's officers proceed on to issue prospectuses to the public, when a copy of that prospectus has not been received by the registrar, then that is going to be an offense for which the company officers responsible are going to be liable to pay a fine. It shall also be an offense to invite for subscriptions, of company securities, subscription of company securities unaccompanied by a prospectus, So this rule or this offense is simply prohibiting any invitation to the public for which no prospectuses should be issued. So if you are targeting any public invitation, then that invitation must be accompanied by the issuing of a prospectus, where we are saying it is going to be an offense to the responsible company officers where they are inviting for subscription of the company securities where a prospectus has not been issued, where a prospectus is not accompanying the invitation for the subscription. To further offenses, where we're saying it is also going to be an offense to, issue a prospectus, containing an expert containing an expert statement without their consent, without their consent. Now, what this offense is prohibiting is the issuing of prospectuses that purport to contain opinions or statements given by experts, where the consent of that expert has also not been obtained. So if you are to issue a prospectus with an opinion of an expert accompanying it, then also get the consent, the endorsement of that expert to go along with the prospectus, so that this offense says or prescribes that it is going to be criminal to issue a prospectus containing a purported statement of an expert whose consent does not accompany the prospectus. The other offense is that it is going to be an offense to issue a prospectus. It is going to be an offense to issue a prospectus without the necessary attachments or endorsements or annexures, as we call them. An attachment is also known as an endorsement or an annexure. So what kind of attachments are we thinking about? So those prospectuses that have expert statements must also be accompanied by the written consent of such expert, such that it is criminal not to have that attached. Prospectuses that are carrying with them financial statements, those financial statements will be an annexure, will be an attachment to the prospectus, such that it shall be an offense not to have those financial statements attached to the prospectus if this company is to issue that prospectus. To more of those offenses, we have some more. Should be number, this is 4, should be number 5. It is an offense to issue a prospectus. It is an offense to issue a prospectus containing an untrue statement. It is an offense to issue a prospectus containing an untrue statement. That it shall be criminal to issue a statement or to issue a prospectus containing false, incorrect, wrong statements. This is intended to protect the consumers of the information from misrepresentations. That you are not going to make prospectuses and issue with it misrepresentative statements, statements whose truthfulness you cannot account for. Now, this liability shall be to the person issuing the statement. That the person issuing the statement that turns out to be untrue shall be the person to whom criminal liability in respect of the untrue statement goes to. Now, we have some special circumstances where these persons issuing untrue statements could also have some reasonable defenses against any action brought under this offense, where we are saying a statement was issued in the prospectus, and this statement turned out to be untrue. The statement turned out to be a false statement. Now, the person issuing the statement could come in with some very good defenses, such as where they are saying they had all reasonable grounds to believe that the statement was true, and actually they believed the statement to be true. In that case, their liability for the untrue statement would be extinguished. We also have circumstances where an untrue statement has been issued and the person issuing the untrue statement has also withdrawn such statement and given reasonable public notice, so that their defense is, At the time when they issued the statement, they believed it to be true. When they realized that the statement was not true, they withdrew the untrue statement and issued reasonable public notice of their withdrawal of the untrue statement. So class, for all this conduct or omissions, there is going to be criminal liability imposed on the responsible persons by the law relating to the prospectuses. I now want to discuss civil liability. Civil liability. Under civil liability, we are looking at third parties. Any third party who suffers loss, any third party who suffers loss by reason of relying on an untrue statement contained in the prospectus. Any third party who suffers loss by reason of relying on an untrue statement contained in the prospectus. So they have received the prospectus, they have read the prospectus. The prospectus did contain a statement that was untrue, that they relied on to make a decision to subscribe for the shares of this company. It is as a result of that subscription that they are saying or claiming that they have suffered loss. They have civil liability both as at statute and at common law. They can claim both under statute and at common law. At statute, they are claiming for compensation. They will be claiming compensation for loss suffered, where under common law, they shall be suing for damages. They shall be claiming damages for misrepresentation. They shall be claiming damages for misrepresentation. It is also possible that they can claim rescission of contract. This is rescinding the contract of the purchase of the shares. That at common law, I bought shares on the faith of a statement that was contained in the prospectus, and this statement has now turned to be untrue. The innocent party, the suffering third party, may be claiming rescission of contract. I want to rescind the contract of purchase of shares on the basis of the misrepresentative statement, on the basis of the misleading statement contained in the prospectus. They could also be claiming damages, monetary compensation for any particular loss, monetary loss suffered. That is under common law. Then we are saying, as far as the Companies Act is concerned, it provides for a possible compensation that can be claimed by the suffering third party from specific persons. So who are these persons that we could be claiming compensations from? Persons liable for untrue statements contained in the prospectus. Persons liable for untrue statements contained in the prospectus. Now, we could be claiming compensation from every person who was a director, at the time of issue. Every person was a director at the time of the issue. We could also be claiming from every person who allowed themselves, to be named to be named as directors, who allowed themselves to be named as directors. We could also be claiming from every person who had agreed to become a director, after some time. We could also be claiming from every person who authorized the issue of the prospectus. So that is the spectrum of all persons on which this civil liability is lying on them. And these are persons under the statute that we can be claiming compensation from. So class, that is the story of the prospectus. It should be bringing us to the end of this third class. Just to recap what we have done, we have looked at what the prospectus is. We have also looked at the essentials of a prospectus. We have looked at the contents of the prospectus, which are primarily supposed to give the potential investor all the relevant information they need in order to base their decision on whether they are going to buy the shares or not. Then we have also looked at the liability in respect of prospectuses, criminal and civil liability. This liability is for the purposes of ensuring the requirements of the Act in relation to the preparation and the issuing of the prospectuses have been complied with. Thank you very much.
Greetings and welcome back to the lesson. The chapter is Theories and Models of Public Policy. Today we are moving on to the fourth, this is the fifth subtopic, which is public participation in public policy. Public participation in the public policy process. So we'll be studying in this lesson the numerous ways for the public to engage and influence policy making, ranging from informal to formal methods. We also take time to highlight some of the benefits of public participation in the policy making process. So there are two things we'll study in today's lesson. One is the numerous ways for the public to engage. So by the end of this lesson, you should be able to explain the numerous ways in which the public can participate in the public policy making process. You should also be able to highlight some of the benefits of participation of the public in public policy making process. So we are going to, first of all, study the methods or methods. And these methods, we're going to group them in various categories. There are methods related to direct engagement. The members of the public can engage directly through public forums and town hall meetings. One, public forums, town hall meetings. The public can engage directly. This is engaging face-to-face with the policymakers and share their perspective on specific areas. This is where there is a meeting organized between the policymakers and the members of the public. Could be in a public place like a town hall meeting, and the policymakers engage with the members of the public face-to-face. You can also have community meetings. Members of the public can also participate through community meetings. through assemblies. These are local discussions, and the members of the public can have local discussions and contributing of ideas that shape community level policies. At the community level, candidates, the members of the public can engage directly through community meetings. We may have public hearings. 3, public hearings, or what we may call open mic sessions, where the public may voice their opinion before legislative bodies or before administrative agencies, and so on. Public hearings. Lobbying and advocacy. The members of the public can join or collaborate with the existing advocacy groups to push for desired policy changes or to defend against ones that they oppose. Advocacy, lobbying and advocacy. That is direct engagement by joining lobby groups, by joining advocacy groups to either support policy changes or oppose. So these are ways, 4 ways in which the members of the public can engage directly. You may also have collaborative engagement. Collaborative what? Collaborative engagement. This is direct engagement. Collaborative engagement. What are some of the ways in which the public can engage collaboratively? One is citizen advisory committees. Through citizen advisory committees. Citizen advisory committees or even commissions. The members of the public can work directly with committee members or policy makers on specific policy areas, providing their expertise and also feedback. Citizen advisory committees and commissions. Two, participatory budgeting. Participatory budgeting. This means participating in collaborative decision making on how to allocate public funds in the community. Collaborative engagement, participative budgeting. Members of the public can participate to that extent. Three, community visioning. Another way to collaborate, to participate collaboratively is through community visioning and planning initiatives. Community visioning and planning initiatives. Now here you can contribute to shaping the future of your community by participating in long-term planning of the community's agenda or processes, long-term planning processes. From the word vision, there may be a time when the community is to set long-term plans. At that point, then one can collaboratively participate with the rest of the community members in policy development. Four, collaborative problem solving. Collaborative problem solving. This means working directly with the policymakers, working directly with the the stakeholders, other stakeholders, to identify solutions to complex problems. Collaborative engagement, right? Collaborative problem solving and also co-creation initiatives. Co-creation initiatives. Another category, we've identified direct engagement, collaborative engagement, then you may have digital engagement. Digital engagement. Digital engagement. How can the members of the public engage digitally? One way is through online consultations and surveys. Online consultations and surveys. This is by way of providing feedback on proposed policies through online platforms, through online surveys, and so on. That is another way in which the members of the public can participate in public policy process. 2, petitions. Electronic petitions. We may have, other than electronic petitions, we may have online advocacy campaigns and online advocacy campaigns. E-petitions and online advocacy campaigns. This may be through gathering of signatures and raising awareness online for issues that one cares about. Digital engagement. 3, social media engagement. Social media engagement. Now here, candidates, the one can engage by having discussions on policy issues, by sharing information, and engaging with the policymakers and fellow citizens online. That is social media engagement. We may have 4, what we call crowdsourcing platforms. Here one can contribute ideas, can participate in collaborative brainstorming initiatives for policy solutions. Crowdsourcing platforms. You understand? So these are 4 methods on digital engagement. We may also have other methods participating other than direct engagement, other than collaborative engagement, other than digital engagement. We have other methods, additional methods like submitting written testimonies, submitting written testimonies, or even comment letters. One can share detailed thoughts, detailed analysis on specific policy proposals in writing. 2, contracting elected leaders. One can participate by contacting the elected leaders or officials. One can write to the leaders, call the leaders, email their representatives like members of parliament at various levels of government in order to share their concerns and suggestions on policy matters. 3, one that is rarely used is organizing protests, organizing marches, stroke marches. Marches here means marching. You can organize, you march, put on t-shirts and march in the streets. You can organize demonstrations, right? Peaceful demonstrations. And the purpose is to raise awareness and call for policy changes. Because like in the Kenya Constitution, demonstrations, peaceful demonstrations are allowed, right? That is one way to participate in public policy process. You can organize protests, you can join marches, you can demonstrate. Why? So that you can create awareness. Because sometimes when demonstrations happen, the media, it catches the attention of the media. The issues are then publicized, and the policymakers are able to learn about the issue, create awareness, and that's one way in which you can participate in public policy making process. Then one can also support organizations that are focused on policy advocacy. Support organizations that are focused on policy advocacy. Because we know some of these organizations are not profit-making organizations. So one can participate by donations, by volunteering with the organization's work. All right? One can donate money or can donate time, can volunteer money, can volunteer to donate money, volunteer to work for the organizations free. They can also help such organizations in pushing for policy changes. Supporting organizations that are focused on policy advocacy is one way to participate in the public policy process. So these are benefits, not benefits, but methods, other methods. So we categorize methods of public participation in 4. All right, is that clear? We categorize them in 4 groups. Direct engagement. We've identified public forums, town hall meetings, community meetings, public hearings, lobbying and advocacy. Then the second category here is collaborative engagement. 1, citizen advisory committees and commissions. Number 2, participatory budgeting. Number 3, we have community visioning and planning initiatives. Number 4, collaborative problem solving. Then the next category here is digital engagement. One can engage digitally by having online consultations and surveys, e-petitions, and online advocacy. Then we have social media engagement, crowdsourcing platforms. Other methods include 1, submitting written testimonies. 2, contacting elected leaders. You can call elected leaders, you can email, you can SMS, and so on. Then organizing protests and demonstrations. 4, supporting organizations that are focused on policy advocacy. So these are ways in which members of the public can participate in public policy making process. We are now going to highlight some of the benefits of public participation. Benefits of public participation, because candidates, the benefits of public participation in the policy process are numerous and impactful, which reach across various aspects of policy making and the society. So what are these benefits? Now, the first benefit of public administration is that, public participation, benefits of public participation is that public participation leads to enhanced decision making. leads to more informed and effective policies. 1. More informed and effective policies. Why? Because diverse perspectives and also first-hand experiences from the public enriches the policy-making process, leading to solutions that consider wider range of needs and realities. When members of the public are involved in the public policy process, then it will lead to more informed and effective policies. 2, identification of blind spots. Public participation can help the policymakers to identify blind spots, including unintended consequences. Because public policy can help uncover potential problems with proposed policies before they are implemented, thereby saving time and resources. So, public participation can identify blind spots and unintended consequences. 3, increased creativity. Public participation can increase creativity and innovation. Why? Because engaging with diverse voices can spark new ideas, can spark new solutions that might not have been considered otherwise. 4, it leads to greater public trust. Public participation in the policy process leads to greater public trust. How? Because when citizens feel their voices are heard and considered, they are more likely to trust and accept the policies. And that can lead to better cooperation and less resistance when it comes to implementation. 5, fosters sense of ownership. Public participation fosters a sense of ownership, a sense of responsibility for policies, leading to greater civic engagement and participation. You understand? 6, it can lead to improved policy implementation. Improved policy implementation. Public engagement can help identify potential challenges and hurdles in the implementation of the policies, and that allows for adjustments and also solutions to be developed before problems arise. 7, community buy-in. Community buy-in. What does that mean? That means that the public participation requires public cooperation. It may also require behavioral change. So when the members of the public cooperate, they get to understand the policy better, and they buy the idea, they buy the policy, they accept the policy. This is opposed to when policy is thrown down their throats, and which may lead to resistance. So buying is just opposite of resistance. The members of the public accept the policy before it is implemented. Why? Because they were involved at every stage of the process. So after they have owned the process, then they can easily buy in. All right? Community buy-in. Next point, number 7. Public participation can also lead to strengthened democracy. So active participation empowers citizens and also strengthens democratic principles. Why? Because it gives people a voice in shaping their communities and also shaping the nation. Seven, eight, public participation can also foster political education. It can foster political education and awareness, leading to a more informed and engaged citizenry. So these are 8 benefits of public participation in the public policy process. There are many other benefits like improved social cohesion. It can lead to improved social cohesion. It leads to improved social cohesion. It leads to improved community building. Public participation can bring people together to work towards community goals, because remember, these are people who come together. For example, they meet in town meetings, they talk together. We have public gatherings, community meetings, town hall meetings. When people assemble together to participate on a common goal, then it improves social cohesion, and that is one advantage of public participation. 10, it leads to enhanced problem solving skills. It enhances problem solving skills. Public participation enhances problem solving skills and capacity building, because candidates' participation in the policy process can develop valuable skills like critical thinking, skills like communication, skills like collaboration, and so on. I can add accountability and transparency. Leads to greater accountability and transparency. Public participation can lead to greater accountability and also transparency. Do you understand? Greater accountability, greater transparency through engagement, through public participation. There is public scrutiny, which can encourage policymakers to be more transparent and accountable for their decisions. So public participation can lead to greater accountability and transparency. So these are benefits of public participation in the public policy process. And it's important to note that public participation is not without challenges. There could be such challenges like ensuring inclusivity, because when you are having meetings, not everyone may have an opportunity to participate. So inclusivity may be a challenge. There could also be the need to overcome power imbalances, the need when during participation to manage conflicting voices. However, when done effectively, the benefits of public participation far outweigh the challenges, leading to a more just, equitable, and also effective policies that serve the needs of all. So the benefits outweigh the challenges. We've highlighted 11 benefits. You can see It's only that I didn't have enough space. Otherwise, I would have continued identifying the benefits of public participation, beginning with the, we said that it leads to more informed and effective policies, identification of blind spots and unintended consequences, increases creativity and innovation, leads to greater public trust, fosters a sense of ownership, leads to improved policy implementation, greater community buy-in, strengthens democracy, fosters political education, improves social cohesion, enhances problem-solving skills like critical thinking, communication skills, and so on. Then lastly, leads to greater accountability and transparency. That is the end of the lesson. In this lesson, under the chapter Theories and Models of Public Policy, we discussed public participation in public policy process. We've identified in this lesson the methods or ways in which the members of the public can publicly engage the policymakers. We've also gone ahead to identify 11 benefits. And in closing, I mentioned a few challenges that can come with public participation, including the ensuring inclusivity. There could be power struggles, so balancing or overcoming power struggles can be a challenge. Managing conflicts during public participation may also be a challenge, but we've stated that the benefits of public participation far much outweigh the benefits, and therefore when public participation is incorporated in public policy process, then it can lead to an equitable, just, and effective policies that serve the needs of all. That's it for today's lesson. I'll give you 3 questions. 1, how does public participation contribute to the legitimacy and effectiveness of public policies, and what are some of the mechanisms used to facilitate citizen engagement? Number 2, what are the barriers to meaningful public participation in the policy process, and how can policymakers overcome these challenges? Number 3, provide examples of successful cases where public participation led to the improvement or revision of existing policies. Thank you for attending the lesson. In our next session, we are going to study the benefits of public policy in national development. Bye. Greetings and welcome to the Public Sector Governance, Policy and Administration Learning Session. Today we are going to study the 6th subtopic. The first topic or second topic, which is the interface between the county and national governments. The interface between the national and county governments. That is our today's lesson. Now, candidates, the interface between the national and county governments in Kenya is defined by the Constitution of Kenya, which sets out the distribution of powers and functions between the 2 levels of government. The Constitution recognizes the interdependence and cooperation between the national and county governments in the governments of the country. These are not autonomous, distinct governments. No, the Constitution recognizes that the national government and the county governments have to depend on each other. There ought to be cooperation between the national and county governments in the governance of the country. And the national government has the responsibility of ensuring that county governments operate effectively and efficiently, while the county governments have the responsibility of implementing and managing services and functions at the county level or the local level. And the Constitution provides a number of mechanisms for the interface between the national and the county governments. That's what we are going to study in our today's lesson. Interface between the national and the county governments. The first mechanism is what we call the national county coordination. National county coordination. The Constitution establishes the Intergovernmental Relations Act, which provides for the establishment of the Intergovernmental Relations Tribunal, a technical committee, right? And this committee facilitates the coordination and cooperation between the county and the national government, between the county governments and the national governments. So there is what we call the national county coordination. The Intergovernmental Relations Act provides for the establishment of the Intergovernmental Relations Technical Committee. You understand? The intergovernmental relations. This is a committee that is established by an act of parliament known as the Intergovernmental Relations Act. And I've said that one of the key functions of this committee is to facilitate coordination and cooperation. Coordination and cooperation between the county governments and the national government. That is one mechanism for the interface between the county and national governments. Number two, sharing of revenue. Sharing of revenue. The Constitution provides for a revenue sharing formula between the national and the county governments, with the national government providing funds to the county governments to support their operations and the provision of services. That is another mechanism for interface between the national government and the county governments. Sharing of revenue. Revenue that is collected at the national level is expected to be shared between the national government and the county governments. 3, concurrent functions. Concurrent function, not current, but concurrent functions. Some functions are shared between the national and county government. They are shared, such as agriculture, health, functions such as trade. They are shared. That means that the national government performs such functions as the same functions as the county government. They are shared by both the national government and the county governments, like agriculture functions around trade, functions around agriculture, trade, industry, and so on. And if they are shared, then there is need for coordination between the two levels of government. So that is another mechanism for interface between the national government and county governments. Concurrent functions. 4, dispute resolution. Dispute resolution. Now, the Constitution provides for mechanism for resolving dispute between the national and the county governments, including negotiation, mediation, and ultimately through the courts. Dispute resolution is another mechanism for interface between the national and county governments. We've seen that these two institutions ought to work together, and we all know that disputes are unavoidable. So there is a mechanism for resolving dispute. The Constitution provides for mechanism for doing what? For resolving disputes between the national and county governments. And such mechanisms are through negotiation, through mediation, and also if mediation and negotiation does not work, then ultimately then there are courts to help in resolving any conflicts that may arise between the national government and also the county governments. 5. Council of Governors. There is such thing as Council of Governors. The Council of Governors is a body established under the Constitution of Kenya to promote cooperation between the national government and the county governments. And the council is made up of the 47 governors, and it's responsible for coordinating the functions of the county governments. 6, we can highlight the National and County Governments Coordination Summit. National and County Government Coordination Summit. National and County Government Coordination Summit is yet another mechanism for interface between the county government and the national government. Currently, the National and County Government Coordination Summit is a forum that is established to facilitate the dialogue between the county government and the national government. It is a forum that has been established to facilitate dialogue, to facilitate consultation between the national and county governments on matters of common interest. So these are mechanisms to help us understand the interface between the county and the national government. So thank you for attending the lesson. Here is your today's assignment on the interface between county and national government. Exercise number 1 is what mechanisms are in place to facilitate cooperation and coordination between the national and county governments in policy implementation. 2, how do disputes between the national and county governments typically get solved in your country? 3, describe a recent example of successful collaboration between the national and county governments in addressing a significant issue. Thank you for attending the lesson. In our next session, we are going to study statutory provisions for conflict resolution in Kenya. Bye-bye. Hello, everyone, and welcome back to the learning session for the subject Public Sector Governance, Policy and Administration. Today, we continue with topic number 2, which is government organization, functions, and practices. In today's session, we are going to focus on the role and responsibility of the certified secretaries and governance auditors in management of government. These are 2 offices or individuals, the certified secretary and governance auditor, or certified secretaries and governance auditors. What is the responsibility and roles of certified secretaries and governance auditors in management of government? So by the end of this lesson, you should be able to explain the role and responsibility of certified secretaries and governance auditors in management of government. We will start with the role of certified secretaries. Now, candidates, certified secretaries play an important role in the management of government. They are trained professionals who possess a wide range of skills and expertise that are essential for effective management of government. And in this lesson, we are going to study some of the roles and responsibilities of certified secretaries in the management of government. The first role, number 1, is providing administrative support. Certified secretaries provide administrative support. They provide, or they are responsible for providing administrative support to government officials and also to government departments. They perform tasks such as record keeping, scheduling appointments, organizing meetings, and so on. Administrative support to government officials. They provide administrative support to ministries, to departments, to agencies within the government. Then another role is in relation to legal compliance. Legal compliance. Certified secretaries ensure that government departments and officials comply with legal and regulatory requirements. They ensure that government policies and procedures are in line with the legal and regulatory frameworks. You understand? Legal compliance. They ensure that the government departments, that government officials comply or obey or adhere to legal and regulatory requirements. 3, risk management. They also have a role in relation to risk management. Certified secretaries identify, they assess, and also manage risks in government departments and government functions. That is to say that they ensure that risk management policies and procedures are in place and that they are followed by government officials and government departments. Risk management, they assess risk. After identifying, then they manage the risks within government. 4, strategic planning. Strategic planning. They also have a role in relation to strategic planning. They assist in the development of policies, the development of strategies that align with the overall objectives of the government. They play a key role in strategic planning. Financial management. Financial management. Now, certified secretaries provide support in financial management to the government. All right? They get involved in financial management in government departments and functions by preparing budgets, by monitoring expenses, by ensuring that financial records are accurate and up to date. Human resource management. Human resource management. Certified secretaries are responsible for managing human resources in government departments, in government functions, in government agencies, and so on. They are involved, they get involved in recruitment, they get involved workers, they got involved in performance management, in training, and also development of government officials. Human resources management. 7, communication. Communication. They play a key role in communication of information, disseminating information within government. They help in communication in government departments and functions. They ensure that information is disseminated to the relevant stakeholders and that communication channels are effective and efficient. Roles of certified secretaries in government. So these are 7 roles: providing administrative support, ensuring that officials in government comply with the legal and regulatory requirements. They help in identifying and assessing risk and also managing risk. They play a pivotal role in strategic planning. They help the government in relation with the financial management issues. They help to manage human resources within government by helping in the recruitment, in performance management, in training, in development of workers within the government. They also ensure that communication within government is efficient, is open, is effective. So generally, candidate certified secretaries are essential in management of government functions in Kenya because they provide valuable expertise and support in a wide range of areas, including administration, legal compliance, risk management, strategic planning, financial management, human resource management, and communication. So these are roles of certified secretaries in management of government. We want to study the roles of the governance auditors. Role of governance auditors in management of governance. And candidates, governance auditors play a crucial role in management of government. These governance auditors candidates are experts. They are professionals who are trained to assess the effectiveness of governance structures, systems, and processes within government institutions. Do you understand? Governance auditors, I repeat, are professionals who are trained to assess, one, the effectiveness of governance structures, two, systems, three, processes within government institutions. And later on in this certified secretary syllabus, we'll be looking at in detail. There is a subject that deals with the how to audit government institutions. Okay, all right. This as an area we will be looking at later on, looking at the functions, the procedures of how to audit government structures, systems, and processes. But here we will only mention some of the responsibilities of governance auditors in management of government, including conducting audits. One, they conduct governance audits because governance audits should be distinguished from financial audits. So governance auditors conduct governance audits. They are responsible for conducting audits of government institutions and processes to identify areas of weaknesses and opportunities for improvement. They use various audit techniques. They use various audit tools to assess governance structures and processes. Two, they provide advice. They provide advice. Governance auditors provide advice. They provide recommendations to the government on how to improve governance structures and governance processes. They work closely with government officials to develop strategies and also plans to address weaknesses and improve governance. Three, assessing risks. They also identify and help in assessing risks. All right, they assess risks that are associated with government activities and provide recommendations on how to manage those risks. They also help government officials to develop risk management plans and processes, assessing risks. Number four, performance evaluation. They evaluate performance of government institutions and processes to determine whether they are achieving their objectives. They may use performance metrics. They may use performance benchmarks in order to assess the effectiveness of government structures and processes. Performance evaluation. Ensuring compliance. Ensuring what? Ensuring compliance. Government auditors ensure that government institutions and processes comply with legal and regulatory requirements. Because when auditing candidates, they examine the compliance of the government with existing laws, regulations, and so on. So they help the government to ensure to comply. They identify areas of non-compliance and provide recommendations on how to address such areas, ensuring compliance with legal and regulatory requirements, because the government is required to adhere to various laws, the constitution, the various acts of parliament, the standards, reporting standards, the international public sector accounting standards, and all that. So the governance auditor ensures that the government complies, and where the government does not comply, where there is non-compliance, these auditors help, they develop recommendations to help the government to adhere to regulations, rules, and requirements. 6, they provide training. Another role is training. Governance auditors provide training to government officials on governance practices, on best practices in governance. And they also train on how to implement them. They provide guidance on how to maintain effective governance structures, how to maintain effective processes, and so on. So these are 6 roles of governance auditors in management of government. We've said that they play a crucial role in the management of government. They provide valuable advice, expertise, and support in areas such as auditing, advice, risk management, performance evaluation, compliance, training, and so on. And by improving governance structures and processes, governance auditors help to enhance the effectiveness and efficiency of government institutions and functions, and also ultimately improving service delivery to citizens. So that's all, candidates, as far as the role of certified secretaries and governance auditors is concerned. We began by highlighting 7 roles of certified secretaries in management of government. 1, certified secretaries provide administrative support. They ensure the government complies. This is legal compliance. They also help in identifying, assessing, and managing risks. They play a crucial role in strategic planning. They help in financial management matters. They also help in management of human resources and help in dissemination of communication within government. Governance auditors, we've seen, they conduct audits, they provide advice, they assess risks, they perform evaluations, they ensure compliance, and also provide training. So that effectively brings the lesson to an end. But as it is our custom, I will give you today's assignment on role and responsibility of certified secretaries and governance auditors in management of government. Number 1, what are the primary responsibilities of certified secretaries in ensuring effective governance within government institutions? Number 2, how do governance auditors contribute to enforcing transparency and accountability in government management practices? Then lastly, provide examples of how certified secretaries and governance auditors have played pivotal roles in improving governance performance in Kenya. Thank you. God bless you. In the next lesson, we are going to study management of the political environment. Greetings and welcome back to the lesson. The subject is public sector governance, policy and administration. We are still on topic number 3. The lesson is public policy formulation processes. In this lesson, we are going to study the public policy formulation process. We will highlight the stages involved in the policy formulation process. We also study or highlight the actors in this process and their roles. So, candidates, the formulation of public policy involves a complex and often an iterative process that involves a range of actors and stakeholders. So it's a complex process that involves many actors, and the process begins with agenda setting. Agenda setting, these are the steps in this process. Step number 1, agenda setting. Setting of the agenda. The first stage of the policy formulation process involves, first of all, identifying and defining the problem or defining the issue that the policy is intended to address. There can be no policy without a problem. Policies are put in place to address specific problems. So policies are driven by problems. That is what to say, that policies are driven by problems. So there has to be, first of all, the definition of the problem, the definition of the issue that calls for formulation of policy. And that may involve analyzing data, conducting research, consulting the stakeholders, and engaging with the public to determine which issues should be given priority. So agenda setting involves defining the problem. And how do you define problem? You talk to the people who are affected by the problem, because people may have many problems. But out of the many problems, which one should be addressed first? Which one needs policy? So the policymakers ought to analyze data. They may be required to conduct research. They may be required to consult with the members of the public and the interest groups. Agenda setting. Number 1. Number 2 is policy analysis. Policy analysis. Policy analysis. Analysis of policy. Now, once a problem or issue has been identified, then the policymakers engage in policy analysis in order to develop and evaluate what we call potential policy options. Because candidates, a single problem may have many alternative solutions. So there has to be the analysis of these potential policy options. This may involve considering various policy instruments. You recall previously we talked about policy instruments, which are tools that the government may use to address problems in the society or community, like laws, programs, resource allocation, and all that. Those are policy instruments. All right? So the second step is to analyze policy, the potential policy options. And that may involve considering various policy instruments, examining the costs vis-a-vis the benefits of different options, and also assessing the political feasibility of different approaches. Policy analysis. I repeat, a problem may have different solutions. One problem may call for different policy options. There could be many alternatives to solve a problem. So before the government settles on the policy to formulate, it has to carry out policy analysis, which is the analysis of the potential policy options. I've explained how that is done. Then the third step is policy formulation. Formulation is derived from the word form, to create, to develop. Policy formulation. So, candidates, policy formulation is based on policy analysis. It's based on the results of policy analysis. So based on the results of policy analysis, the policymakers develop and refine specific policy proposals. Because here the government deals with different policy proposals or options. So here, when in formulating policy, then it may be need to refine, it may have various options which can be refined into one proposal. Just at this stage, the policymakers draft. At this point, the policymakers draft what we call policy language. They develop policy language. And they do so by consulting with the stakeholders and seeking input from experts, seeking input from different policymakers, and so on. So are you following, candidates, the procedure? Number one, define the problem. Set the agenda, policy agenda. All right? Analyze data, conduct research, consult with stakeholders to find out what the problem, define the problem or define the issue that the policy is intended to address. Then come up with proposals on how to address the problem, policy analysis, proposals on how the problem can be addressed. Then formulate policy. Out of the analysis that is done here, come up with, formulate the policy. And how do you formulate policy? You formulate policy based on the results of policy analysis. Develop and refine specific policy proposals. And that may involve, I've said, drafting policy language. Right? 4, here the policy has been formulated. You have put it in words, written down these words to it. You've drafted the language. Then step number 4 is to adopt, policy adoption. Once a policy proposal has been developed or formulated in step number 3, then you adopt it. It must be adopted by the relevant policymakers or the relevant policy-making bodies or body. And that may involve a range of procedures, a range of political considerations. It may include legislative approval. It may include executive action. It may include bureaucratic decision-making, depending on the policy. There are some policies, before they are adopted, they may need to have cabinet approval or legislative approval, and so on, depending on the policy that what has been developed in step number 3. Then it's adopted through various ways, like bureaucratic decision making, depending on what the law says as far as the development and adoption of that policy is concerned. Then step number 5, implementation. You implement it after it has been adopted, maybe by, we say, through legislative. We gave a legislative approval, executive approval, bureaucratic decision making, and so on. After it has been adopted, then implement it. After it has been adopted, it must be implemented in a way that achieves its intended objective. The purpose for adopting or developing a policy is so that it can address a problem that was raised in step number 1. When it comes to implementation, then that policy has to be implemented in a way that solves the problem that was intended to solve. It must be implemented in a way that achieves its intended objectives or goals. And that implementation may involve developing regulations, creating programs. It may involve allocating resources. It may involve coordination among multiple actors, among different agencies of government, and so on. Implement the policy according to the original plan to solve the problem that necessitated the need for formulation of that policy. You can guess number 6, evaluation, policy evaluation, evaluation of policy. Now, candidates, here, under evaluation, policymakers must evaluate the effectiveness of policy in achieving its objectives and goals. Policymakers must do what? Must evaluate the effectiveness of the policy in achieving its goals. And that may involve monitoring. It may do what? May involve monitoring. Because after implementing, then you monitor, you observe, you assess outcomes, assess the outcomes, monitor the implementation process. It may involve measuring program performance, if it is a program. It may also involve, after doing the evaluation, making adjustments or revisions to the policy as needed. You understand? To monitor if the policy required the distribution of resources in order to solve a problem, then the government has to put in place a mechanism to evaluate if the program is effective by monitoring, by assessing outcomes, and also ensuring that if there are any adjustments that are needed, then that is done, because that's the purpose of evaluating. Because there are some areas that may not be implemented according to the plan, or there could be unforeseen circumstances which may call for adjustments in the policy that has been formulated and implemented. So currently, these are 6 important steps in public policy formulation. 1, agenda setting. Agenda what? Agenda setting. 2, policy analysis. 3, policy formulation. 4, policy adoption. 5, policy implementation. 6, policy evaluation. These are key public policy formulation stages or steps. Is that clear, candidates? And it's important to note that the formulation process is not always linear or sequential, as I have explained. It's not always. Because remember, we say that this process may be iterative. We say it's complex and an iterative process. It may need to back and forth. It's not linear. It's not always that after beginning, because it may happen, candidates, that at the adoption, for example, at the adoption stage, there may be need to redefine the problem. The problem may not have been defined very well. So they may need to go back to definition of the problem even at the implementation stage. While implementing after adoption, they may be need to make adjustments to the definition of the problem. So it is not given that the process is linear or sequential. Policymakers may need to revisit earlier stages of the process as new information or as new insights emerge. There could be some information that was not available to policymakers during the policy analysis. So if new information emerges during evaluation, then there'll be adjustments that are made to the policy. Additionally, candidates, the policy formulation process may involve competing interests, especially when dealing with government resources. There could be conflicting values, conflicting interests. There could be trade-offs between different policy objectives. So it may not be a sequential or easy or linear process. And therefore, effective policy formulation requires careful consideration of all these factors: the competing interests, the conflicting values, the trade-offs. All these factors must be put into consideration, as well as ongoing engagement with stakeholders, because stakeholders, again, are subject to change, may change their values, their needs may change. The people to whom the policy is intended to help, to maybe the problems that are intended to be solved, it may change. So there's need to always have an engagement, ongoing engagement with all the actors. And that takes us to the second part, as I've just mentioned, actors, because I've said for this process to be successful, the policymakers may need to have an ongoing, continuous engagement with the actors. So let us now discuss the actors in the policy formulation process. Who are the actors and what are their roles? Because we have a range of actors and stakeholders involved in public policy formulation, each with their own roles, each with their own responsibilities. Who are these actors? And what is their role? One, politicians and policymakers. Politicians are the elected leaders. Politicians are the elected or the appointed officials who are responsible for making decisions about public policy. They are typically responsible for setting the policy agenda, conducting policy analysis, developing and refining policy proposals, overseeing the adoption and implementation of policies. So the policymakers and politicians, they are key actors in the public policy formulation process. I've highlighted their role. Their role, key role, is that they are responsible for setting the policy agenda. They may be involved in also policy analysis. We talked about development of different proposals to address the problem. They may also oversee the adoption and implementation of the policies. Adoption, here, remember we talked about legislative approval. Those who sit in parliament are politicians. The legislature is a political arm, okay, of government, and they are involved at the adoption, they may be needed to approve a policy that has been developed or formulated. So that is the role of the policymakers and politicians. Do you understand, candidates? Yeah, of course, yes, you do. Number two, bureaucrats and civil servants. Bureaucrats and civil servants. These are government officials who are responsible for carrying out the day-to-day work of developing and implementing public policies. They may be responsible for drafting regulations, for managing programs, for allocating resources, and also coordinating with each other, and also coordinating with the different stakeholders. Bureaucrats are government officials. These are not politicians, but government officials. Civil servants. They play a key role in policy formulation process. They are responsible for carrying out the day-to-day work of developing and also implementing public policy. The third actor is interest groups. Interest groups and advocacy organizations. Interest groups and advocacy organizations. These are organizations that represent specific interests or constituencies. And these are groups that seek to influence public policy. They may engage in activities such as lobbying, public education, grassroots organization. The purpose for involving in public organization is so as to advance their public policy priorities. Interest groups and advocacy organizations. We may also have experts and academics. Experts and academics. These are individuals with specialized knowledge and expertise in specific policy areas such as economics. We may have experts in public health, economics in environmental science, and such like. They may be called upon to provide input. They may be called upon to provide analysis to policymakers during the policy formulation process, particularly at the policy analysis stage. They may also be required to help in drafting the policy language. They are useful at even implementation stage. They may be helpful in evaluating the policy and so on. Experts and academics. 5, media. Media. The media plays an important role in shaping public opinion and also influencing the public policy agenda. They may report on policy issues. The media may report or provide analysis. The media may provide commentary. The media can also conduct investigations that inform and also shape public debate around the policy that is being developed. So media plays a pivotal role in shaping public opinion. The media plays an important role in disseminating information about policy formulation, about implementation, and all these other areas we've been talking about. Media, number 5. Number 6, finally, we have the public. The public is a key actor in public policy formulation because candidates' public opinion and feedback can influence the policy agenda, can shape the policy formulation process, and can also impact the adoption and the implementation of policy. So public engagement and participation are critical to enhance or to ensure that policies reflect the needs and the priorities of the communities they are intended to serve. So policy, remember, at the initial stage, we say that it begins by setting the agenda, by defining the problem or the issue that affects a community or society or a nation. Policy is intended to be of benefit to the general public, and therefore the public is a key actor. The policymakers need public opinion, and such opinion can be helpful in the formulation process. Public opinion can impact the adoption. It can also impact the implementation of policies. So these are 6 actors. I've identified the 6 actors. I've also highlighted some of the roles that they play. Politicians and policymakers, number 1. Bureaucrats and civil servants, number 2. Interest groups and advocacy organizations, number 3. Experts and academics, number 4. The media, 5. The public, 6. Key actors. They are not the only actors, could be more, but these are the key actors. And each of these actors, candidates, plays an important role in the formulation of policy. And effective policy making requires active engagement and collaboration of all these actors, because these are the stakeholders. There ought to be active engagement. Is there any question? If you have any question, please, you can below this video.